Hello everyone, a very good morning to you all. Welcome to the second lecture of Advanced Financial Management paper of ACCA. In the class which we did yesterday, we discussed about the introduction to AFM, right? What all you need to know before you prepare yourself for the exam, correct? And then we started off very briefly on chapter number 1. Let's just revise the slides which we had completed and then we'll move on to a new part for the today's class, right? If you have any doubts from the previous class, please feel free to use the chat box and let me know. I will take it up in the class. All right, let's begin. So the chapter is Financial Strategy Formulation. So within which we understood that investors, they care about the future of the company, the dividend that they are receiving. See, future also decides the capital gain that they would eventually make when they realize or when they sell off their shares. So future, dividend, financing plans, whether it will be financed through debt or through equity, and risk management. Because overall, you have to ensure that the company doesn't become too risky to be even financed. So what did we learn? The primary motive that you should keep in mind for a profit organization is wealth maximization and not profit maximization. We learned that wealth maximization or wealth, it can be measured as dividend yield plus capital gain or loss. And we solved a very small question also on this. And then we learned about investment decisions. So that if a company is earning cash profits, what can it do with it? It can invest in other companies, by making acquisitions of them. Or, it can invest in new projects within its own company. So this is about investment decision. Investment decision is about where it can put its money. Now we discussed the example of Flipkart acquisition of Myntra, and I told you it has done a lot of acquisitions. So I have put this file for your reference. Flipkart has acquired eBay, then Walmart India. Don't get confused with this. Walmart USA acquired Flipkart. Flipkart acquired Walmart India. Okay. So PhonePe, now PhonePe is eventually out, but it was one of the acquisitions which Flipkart had done. ClearTrip, McMocha, Yantra, Sasta Sundar. Sasta Sundar is currently termed as Flipkart Health. So if you have shopped medicines on Flipkart Health, it is nothing but the acquisition which was earlier known as Sasta Sundar. Sasta Sundar is even listed on the stock exchange. Then Myntra we discussed. Okay. Next, we discussed about use of debt finance and we came to the conclusion that yes, debt is cheaper than equity, but at the same time, debt is riskier than equity. So it has to be managed very, very carefully by the finance managers and it comes under the purview of financing decision. All right. So let's just quickly go through this and then we'll understand the practical issues with the use of debt. So one of the main aspects of financing decisions is how much debt a firm is planning to use. You understood the importance of how much debt? You have to manage your weighted average cost of capital, which is a aggregate of weighted equity cost and weighted debt cost. So how much? So it has to manage the weighted average cost of capital and at the same time, it has to manage the risk of the company. So how much debt is very important as a question. A firm is planning to use and whether using debt finance can help to reduce a business's weighted average cost of capital. The level of gearing that is appropriate for a business depends on a number of practical issues. Now let us understand what it means. What do you mean by gearing? Let us see how many of you know what do you mean by gearing. Right, gearing ratio. See, use of debt, whenever debt is used in a company, the company is called geared, leveraged. Yes. So how is it measured? Gearing ratio is measured as debt divided by debt plus equity. That means what is the proportion of debt in the overall capital structure of the company? That is gearing. Remember this. It will come later also, the formula bit. But gearing as a concept, you should be clear. Gearing, a company is called geared if it uses debt in its capital structure. So the level of gearing that is appropriate for a business depends on a number of practical issues. What is the level of debt? Gearing or level of debt, it's the same thing. So first of all, life cycle. A new growing business will find it difficult to forecast cash flows with any certainty. So high levels of gearing are unwise. How many of you have watched Shark Tank? Maybe USA or India, whatever, whichever version. Have you watched Shark Tank? The pitchers who used to come to pitch their business, tell me, they used to pitch for debt or they used to pitch for equity? All of you are telling me equity. Have you ever thought about why they are pitching for equity and not debt? Have you ever thought about it? Why equity and not debt? Why so? Exactly, exactly right. That they are selling. Sorry, there is no cash flow estimation. See, these are new businesses, growing business. They don't know how much cash they will be able to generate. You know, in the initial years when the business is just starting off, the cash flows are very uncertain. And you would have realized with our discussion yesterday that only if the cash flows are certain, then only you should take debt finance. Otherwise, the debt providers can sue the company and even shut it down if the company is not able to pay off its interest and principal on time. So, therefore, new companies prefer equity finance rather than debt finance because the cash flows are uncertain for such companies. So one of the issue or one of the aspects which decides the level of debt is life cycle. If your company is fairly new, you tend to avoid debt. If your company is mature, then you can opt for debt. Okay, so that is number one, life cycle. Number two is operating gearing. What is operating gearing? Have you heard this term? Do you know what is operating gearing? No. Let's discuss about it. Let me open up an Excel file. Let's show it. No, it's not about interest. That's financial gearing. Yeah, have a look at this. So whatever discussions which we do in the class now, like yesterday we discussed this example, you will be getting these Excel files also along with the presentations. So whatever class notes that we do, scribbling thing that we keep on discussing, I put it in a tab here, scribble. So you can later also access this. All right, so let us now discuss operating gearing. Okay. Now you help me prepare the revenue or the profit statement of a company. Very basic profit statement. I'll write revenue is 100. Now let us take a big number, 10,000. Okay, revenue. Then can I say the variable cost? I'll deduct the variable cost. Let us say it is 6,000. What is the resultant called? 10,000 minus 6,000. What is it called? Let's see how much. Salman has answered it. Others, do you know? It is known as contribution. Absolutely right. This is the contribution. From contribution, what do we deduct to arrive at profit? Very good. Fixed cost. So let us say the fixed cost is 2,000. So the profit becomes 2,000. Right? This is a very basic revenue statement, revenue or profit statement. Now, I'm asking you I'm not teaching formulas right now. I'm just asking you logical questions. You answer it. Okay. This is the revenue statement of A company. Similarly, for B company, revenue is same, variable cost is also same, but its fixed costs are 3,800. Okay. So A company and B company. Can you tell me which company is more risky? A company or B company? Which company is more risky? All of you are telling me B. Now answer why. Why is B more risky? Absolutely right. Because company B is more risky because it has high fixed cost. In other words, it means that operating gearing of B company is higher. Okay, so in other words, it means that operating gearing is a measure of fixed cost. Why is it risky? Because if my revenue changes, let us create another scenario for B company. If my revenue changes, and I will make this a proportion 60% again. If my revenue becomes 9,500, just $500, I'm changing my revenue. See, it has come in a loss. Zero profit, zero loss. Or let's just say if I make it 9,400, it has started showing losses 40. It means that a minute change in the sales of the company can make it a loss company because fixed costs will remain constant. So it is known as operating gearing. Finance gearing, see, fixed cost will include this interest also, but other fixed costs as well. So it is not just the resultant of interest cost, which you all were saying when I earlier asked you this question. So operating cost is a resultant of, fixed cost is a resultant of all the other costs also which are fixed in nature, not just interest. And operating gearing, it shows if it is considered to be high, if the fixed costs are high. Okay, so I'll just remove this part. This is relevant for you to understand the concept of operating gearing. So in other words, it means that operating gearing of B company is higher. Now you come back and read this statement, it will make all the more sense. It says operating, if fixed costs are a high proportion of total costs, then cash flows will be volatile. I just showed you a case of volatility, that if the revenue changed by $600, the company became a loss-making company. So high gearing is not sensible. Now what does it mean? Let's come back. It means that, therefore, a company with high operating gearing should avoid more debt to avoid its financial gearing, or to avoid its overall gearing. Financial plus operating gearing from becoming higher. So it means to say, if you are risky on the operational front, like another way could be fixed cost excluding interest. Okay, so this is profit from operations, I can say, right? Now you just try to understand this. So profit, already my business is risky. My operating gearing is risky. I've got a lot of fixed costs. So profit from operations itself for B company, I'm saying, it's very less. And if the number changes, let's write it down. If revenue for B company changes by 6%, the company would become loss making. This shows that high operating gearing increases volatility of a company. Please have a look at the example and let me know if you have understood the concept. Take a moment, look at the numbers, read the explanation and tell me if you are able to understand that what is it? What is the conclusion? The conclusion is if your operating gearing is high, you need to avoid taking debt, because if you take more debt, so your financial gearing will also become high. So your overall gearing will also become high. When the gearing is high, the business is said to be risky. Is it clear? Yes? Perfect. Let's come back here. Now, what does it say? If fixed costs are a high proportion of total costs, then cash flows will be volatile. I showed you the example just for 6%. If the sales are changing for the company became loss making. So high gearing, high financial gearing is not sensible. So if your operating gearing is high, financial gearing is not sensible. Okay. Next is number 3, stability of revenue. If operating in a highly dynamic business environment. See, life cycle, new company was new and therefore its revenue was not stable. But even for some existing old mature companies, the revenues, they don't seem to stabilize. They are highly dependent on a lot of external factors. So if operating in a highly dynamic business environment, then cash flows will be volatile. So high gearing is not sensible. So if your company may be mature, but if its revenues are not stabilized, then gearing should be avoided, because if in any year the revenues do not come up, then you will not be able to pay off debt, and this could be a very risky situation for the company. Clear? Very simple point. And last practical issue is if unable to offer security, because debt is always secured with some asset. So if your company does not have any asset, then how will you take debt? So if unable to offer security, debt will be difficult. And even if you get it, first of all, you will not get quotes in the market. But even somehow you get a quote, it will be too expensive. The interest rates will be very high for such a debt. So these all aspects need to be kept in mind while deciding how much debt a firm should be using. Is it clear, all the points? Is it clear? Okay. Then let's have a look at some examples which I've put forward for you. Examples of companies with the highest debt. Reliance, this is very recent data. Reliance, it is in the sector of crude oil. And that is how much? 3.13 lakh crores. These are capital intensive companies. And you see how much debt they have. 3.13 lakh crores. Vodafone Idea. Debt is 2.01 lakh crores. Tata Motors, 1.25 lakh crores. So these companies are among the top 10 highest debt companies in India. Okay. RIL is debt free now. I doubt. I took it from the recent data. Maybe. Let's just find out. Okay, if it's true, then we'll correct the slide also. See, let us find out. This is as new as November 23, 2023. Ashish, the top 10 companies, Reliance, have a look here. Check which entity it is talking about, because Reliance Industries per se, it is showing 3.13 lakh crores. And this article is as of 23rd November 2023. Check which entity you're talking about. RIL itself is not debt free, as recent as November end. See, industries to how which, but this is a very old news. This is pretty old. What you're saying, no? This article is of 2022, which says that it is a net debt-free company. So I think post that, recently it has raised debt, and therefore it is showing that high level of debt. It had refinanced debt, and this, have a look. Currently it has debt, but it is of 2022 that you're referring to. Okay, coming back. So this is the status. Reliance has got the high, it is among the top 10 companies having the highest debt in India. Reliance, Vodafone Idea, and Tata. All right, perfect. Let's move to the next thing, which is financial planning and control. So financial planning, in order to survive, any business must have an adequate net inflow of cash. Okay. So like you were asking yesterday, like, can a profit-making company pay dividends only? I said cash profit-making companies can pay off dividends, because ultimately it is a payout. It is actually a cash flow that has to happen for dividend. In a similar way, for all the other expenditures, a company needs cash to survive. So in order to survive, any business must have an adequate net inflow of cash. Then only it will be able to pay off its outflows. So businesses should try to plan for positive net cash flows, but at the same time, it is unwise to hold too much cash. Just imagine you are keeping the cash in your bank account. It will not even be able to fight off inflation. Correct? So you have to ensure that you use your cash in the most optimistic way, the way you can enhance its value over time. Apple has $165 billion cash reserves. Is it? So yes, companies, they have to maintain some cash to finance its the working capital flows. But for a company that of that scale, $165 billion is what would be supporting their operating flows. I'm also looking up, since you have highlighted this. Yeah, you're right. Very good. Have a look. Apple now has $162 billion in cash in hand, according to company's fiscal fourth quarter earnings reports. So they are keeping this much cash, right? Good example. So, this cash, they will obviously, this is the closing cash balance, and definitely they will, may have plans to use this cash, maybe in terms of financing, maybe in terms of dividend, financing, investment decisions. So definitely they'll be using it other than what they need to maintain their regular working capital requirements. So businesses should try to plan for positive net cash flows, but at the same time, it is unwise to hold too much cash, right? Yes, cash. If there were cash pooling arrangements, the cost of debt would also come down. No, Salman, it's not unwise for Apple. Definitely, I'm sure the best of the best finance managers would be sitting behind the desks in Apple. They would definitely have some plans. This is the closing cash balance of Apple, and maybe they would have some plans to deploy it. Either it could, there are three avenues only. It would be either in investment, that they would be acquiring some other company, or they would be financing some other project of their own. Either, or it could be through financing. Where do they plan to pay off? Either they will repurchase. We'll come to how they can use in financing. Like they may repurchase the share, or last would be pay out dividends to the shareholders. So definitely there would be some plans. Okay, so in order to survive, any businesses must have an adequate net inflow of cash. Businesses should try to plan for a positive net cash flows, but at the same, very good. I'll come back to this point. But at the same time, it is unwise to hold too much cash. So Gaurav has also come up with a fact that Apple is in a way investing in Gen AI, artificial intelligence, which is the next big thing for sure, right? So Apple is investing money. So definitely, I said they will have some investment plans. Maybe they don't need it right now, and therefore they're holding it in cash. Eventually, over time, they will be investing it, using it for finance or through dividend decisions, right? So when a company is cash rich, the senior financial officer will have to decide whether to do one or more of the following: plan to use the cash, for example, for a project investment or a takeover bid for another company. As I told you, that they will pay out, they will buy out other companies or do some own project, pay out the cash to shareholders as dividends, and let the shareholders decide how best to use the cash for themselves. And last is repurchase its own shares. They have surplus cash, they can pay back the shareholders, and whoever is buying back, the company can reduce accordingly, manage the control of the company also. So where cash flow has become a problem, a company may choose to sell off some of its assets. So this is for a cash rich company, what all things it can do. But if the company has deficit of cash, then what? A company may choose to sell off some of its assets. However, it is important to recognize the difference between assets that a company can survive without and those that are essential for the company's continued operation. So it is saying basically that if you have cash deficit, you can make up for it by selling assets. But those assets have to be non-critical. They shouldn't be assets which impact the entire operations, without which the company cannot even continue to operate. So therefore, if you are deciding to sell off assets, they need to be non-critical assets without which the business can continue to survive, right? So assets, like I was telling about, assets, critical, non-critical. So assets can be divided into three categories: those that are needed to carry out the core activities of the business. Critical assets. Without plant and machinery, can a business survive? No. Those second category of assets, those that are not essential for carrying out the main activities of the business and can be sold off at a fairly short notice. Example, short-term marketable investments. Third category of assets are those that are not essential and can be sold off to raise cash but may take some time to sell. Example would be long-term investments, or if you have invested in some other subsidiary companies, that. So as I said, two types of assets primarily: critical and non-critical. Critical assets are those without which the business cannot function. Non-critical assets can further be divided into available for, or they can be sold immediately, and the others which take time to sell, right? Short-term marketable investments and long-term investments. So when a company is having cash deficit, it should be focusing on selling these two categories of assets and not the critical or the core business assets. Am I clear so far? Yes? All right, perfect. Then let's move to the next topic, and that is risk management decision. I'll tell you that, this topic, risk management, you are going to do till the last chapter of the syllabus. It's that imbibed in the syllabus. So risk management decisions in the AFM exam mainly involve management of exchange rate and interest rate risk and project management issues. So I'll tell you a brief about what risk management is about. Okay. So and I'm talking from AFM syllabus point of view, you are going to be managing the risk which arises due to exchange rate and second due to interest rate. That is primarily the focus of risk management in the AFM syllabus. Can you give me an example of exchange rate risk? Can you give me an example of exchange rate risk? So let's have a look here in Excel. Exchange rate risk. An Indian importer has dollar 30,000 payable 3 months from now. INR by USD today is equals to 82. Okay. After 3 months, INR by USD turns out to be 95. This exposes the importer to exchange rate risk. Tell me, what is the exposure here? What happened in this scenario? What is going to happen in this scenario? Yes. So this means that the importer would have to pay how much excess? 95 minus 82 multiplied with 30,000. Do you agree? This means that importer would have to pay 3,90,000 INR in excess. So he ended up, basically, his profits would be reduced by this amount. This is what exchange rate risk is. And you, as finance managers, have to manage this risk so that this excess payment does not even come. That you settle off the payables, without any uncertainty. That is what exchange rate risk is. There is a proper chapter on it later, and a very important chapter. We'll discuss that later. Okay. We cannot predict, but there are hedging techniques proper, you know, which you will be learning in the syllabus, with which this risk will not even come. Okay. We are not going to, eh, predict what the rate is going to be. We are going to make sure that, originally he was supposed to pay 30,000 into 82. After 3 months also, he pays around that amount only, 30,000 into 82. He does not expose himself to this increased rate. Now let us take another example of interest rate risk. which the slide talks about. There are proper chapters on these two concepts. Okay. An Indian borrower has taken a loan of rupees 10 lakhs. Okay, an Indian borrower or simply a borrower only. There's no point of Indian or non Indian. A borrower has taken a loan of $1 million. No, would take, not has taken, would take a loan of rupees $1 million after 3 months. Interest rate today is equals to 5%. After 3 months, interest rate turns out to be 6.5%. This exposes the borrower to interest rate risk. This means that borrower would have to pay how much in extra? Take a loan of $1 million after 3 months for 9 months. Okay. How much would he pay extra? Equals to, can I say 6.5? Do your calculations also. You can also do it. Very simple calculations. Percent multiplied with 1 million into 9/12. He'd have to pay $11,250 in excess. So without any fault of his, just with market movements of interest rate, he ended up paying this much extra. Okay, this is interest rate risk. And then we also have chapters which will ensure that, whatever is the interest rate today, even after 3 months, he's exposed to that interest rate. We'll be learning such hedging techniques. Techniques to hedge exchange rate risk would be discussed later. Are you with me so far? Any doubt? Very simple examples I've given to help you explain the concept of exchange rate risk and interest rate risk. If you have doubts, let me know, okay? Perfect, thanks. So let's come back here. So risk management decisions. Now you know what risk management decisions we're talking about. In the AFM exam, mainly involve management of exchange rate and interest rate risk and project management issues. Project management issues will come later in the NPV chapter. Again, the volatility of an organization's cash flows are a powerful influence on its approach to risk management. The more volatile the cash flows are, the more important risk management becomes. So if your business is highly volatile, you need to manage the cash flows very, very carefully. Otherwise, any type of a outflow you're not able to meet, it invites legal litigations as well. Let's move to the next slide. So we have covered, what all have we covered? We have covered investment decisions in short, we have covered financing decisions, we have covered risk management. Now, next thing is dividend decision. Very, very important. A lot of practical questions come from this part. Let us understand this. So as I said, a company, what we saw in the first page itself, that a company can make investment, it can take a financing decision, it could take a dividend decision with the cash that it has. Now, what does dividend decision is? How much dividend a company should be paying. So the dividend decision is related to how much a firm has decided to spend on investments and also to how much of the finance needed for investments is being raised externally. This illustrates the interrelationship between these key decisions. Basically, it is saying that dividends ultimately you would be paying only after you have done the investments and after you have got the sources of finance as per financing decision. So all of these decisions are interconnected. Now let us understand that relationship. What is the influence of the investment decision? If a company is growing, then much of its cash it has it sorry if a company is growing, then much of the cash it has will be better used to invest in positive NPV projects. So if it is a growing company now, it is better to invest on your own rather than giving cash to the shareholders as dividend and letting them decide their investments. So see, understand what I'm trying to say. Do you agree? So a company has two options. Either retain the cash profits, right? Retain the cash profits and invest in positive NPV projects if available. If you have positive NPV projects of your own, you retain the cash and you make investment in such projects. Or the second option is to pay the shareholders in the form of dividend so that they can make investments of their own. Because if the company does not have any profitable avenues where it can put money, then it will give money to the shareholders so that they can invest in whatever opportunities they have in hand. Okay. So this is what the influence of investment decisions is about. Now you come back and read the statement again. If a company is growing, that means it will have a lot of positive NPV projects to invest in. If a company is growing, then much of its cash it has will be better used to invest in positive NPV projects rather than giving it out to shareholders and then letting them think of on their behalf, right? Like shareholders will think that, okay, I invest in this company, I invest in this project, and then they can do whatever they want to do with the dividend. But if you as a company can invest in better opportunities and give your shareholders higher return on their investment, then nothing like it. So if a company is growing, then much of the cash it has will be better used to invest in positive NPV projects. So it will not have the liquidity to pay dividends. So if you are investing in such positive NPV projects, the amount that will be left to pay dividends will come down. You can't do both. Now you have limited cash profits. Either you invest or you pay the dividend. If you have positive NPV projects available in front of you, you should be doing the investment so that ultimately you can give higher returns to the shareholders. Shareholder expectations will often be for low or even zero dividends in these circumstances. The shareholders also know that if they're putting money in these growing companies, then they will not get much dividend because the company would be willing to use the cash profits, whatever it has, in new projects. So influence of the financing decision. So that was about investment decisions, how investment decisions define the dividend payout. Now let us understand how does financing decision decides the payout. in the form of dividends. However, if a company can borrow to finance its investments, basically, so you as a company have positive NPV projects in front of you. And if you have the option to finance it, then you can finance it in the sense that you can raise debt or equity to get the money to finance this new project. So whatever profits that you as a company have made, you can pay it off as dividends. However, there are legal constraints over a company's ability to do this. It is only legal if a company has accumulated realized profits. So basically, it is saying that you cannot borrow if you do not have these realized profits to that extent. Otherwise, what it will look like, that you are taking money to finance the payout of dividends. I'll try to simplify it for you. Have a look. If the projects can be financed, then the company can use the cash profits to pay dividends. Okay, if the project can be financed, then the company can use the cash profits to pay dividend. However, there are legal constraints around this. Finance can be raised only if there are existing cash reserves to pay out dividends, and there is no channeling of raised finance to pay dividends. Please understand that you cannot be raising finance to pay dividends. In some countries, there are legal constraints around this. This very statement, I have simplified for you. Finance can be raised only if there are existing cash reserves to pay out dividends, and there is no channeling of raised finance to pay dividends. There are legal foundations. See, every like Salman, we say na, to each their own. So every country has its own legal obligations, legal laws which they follow. But in most of the countries, you will find that they will not allow a company to raise finance. Imagine it is like taking money from debt providers and putting it in equity shareholders' pockets. It doesn't seem to be legally correct. That is why a lot of countries have banned this. But to each their own. If a country is allowing it, then it's how they regard their uh, shareholders, how they regard the shareholders in their country. Like in India, SEBI is very pro investors. All the rulings and everything which come out, it is with the intent to protect the Indian investors, right? So again, some countries can follow different ideologies. However, if a company can borrow, so now read this again. However, if a company can borrow to finance its investments, it can still pay dividends. There are legal constraints over a company's ability to do this. It is only legal if a company has accumulated realized profits. Okay. Then this is the influence of the investment decision, influence of the financing decision. Now, influence of the life cycle. So dividend policy, it can change during a company's life cycle. In some years, in the initial year, it would have paid less dividend. Eventually, over time, it would have paid more. Okay. So that is about the influence of different aspects on the dividend decisions of a company. So a young company, basically, like Swiggy, you can say, or any startup company you can take for that matter. If you are a young company, then its shareholders will expect either zero or very low dividends. These are high growth investment needs. They themselves burn cash in a way. So from where will they get the money to pay dividends? These are high growth investment needs, wants to minimize debt as cash flows are unstable. So Swiggy is an example for it. Mature companies like ITC, they have very high dividend payouts. Another example would be BPCL. These are very high dividend paying companies. So lower growth investment needs. So they have become very stable. So their growth needs or investment needs are very less. So they say that, we are giving money to the shareholders. Shareholders can do whatever they want to do with this money. So debt is more suitable as cash flows are stabilized. Clear? Dividend decisions influence. Is it clear? What are the factors which influence? Influence of the investment decision, influence of the finance decision, influence of the life cycles. If a company is new, like Swiggy, they do not pay out much dividends. If a company is mature, like ITC, then they can afford to pay that dividend to the shareholders. Fine. Next, very important concept in dividend decision is dividend capacity. See, like we discussed now, how much debt, in a similar way, how much dividend. So if you are thinking of paying off dividend to the shareholders, then how much dividend should you be paying? That is what is decided by dividend capacity. As the name suggests, what is your capacity? What is the maximum dividend you can pay? So investment and financing issues will impact on an organization's capacity to pay dividends. The cash generated in any given year that is available to pay dividend to the ordinary shareholders is called as dividend capacity. Like, what is the money available? You may or may not pay it, but what is it that is available to you? What is the maximum that you can pay off as dividend is what dividend capacity is. It is also known as free cash flow to equity. That means this is the cash attributable to equity shareholders. Now, the company may or may not pay dividend out of it, but this is the maximum that is available for paying off dividends, right? Now, let us understand this very important table. It will come handy. There are a lot of questions in the book which are about this concept. So make sure you understand. It's very simple, nothing to worry also, but you need to remember. So let us come back to Excel. Okay. So let us take for an example, revenue of a company is $100. Operating expenses in excluding depreciation is 40. Depreciation is what? 25. So can I say that is profit from operations? Can I say it is 35? Please tell me. The revenue of a company is 100, operating expenses is 40, depreciation is 25. So profit before interest and tax, that is profit from operations, is 35. Then comes interest. Interest is 5. PBT is 30. Profit before tax. Now taxes, let us say at the rate of 30%. It is 9. 30% into 30, it's 9. So PAT is 21. Till here, all of you would have prepared P&L in your life sometime. Now, add back. Now, I have to find out what? Requirement is what? Objective of dividend capacity, objective is to find out cash available to pay as dividends to shareholders. Objective is to find out cash available to pay as dividends. Now think and answer, is this PAT cash profit? Think and answer, is this PAT cash profit? No, it is not, right? Very good. What do I need to do? I need to add back depreciation 25. Okay, this is added back. Then add after considering the influence of investment and financing decisions. Right, this is the objective. Now you have added back depreciation because it is a non-cash item. Agreed. Then you have to consider the impact of or the influence of investment and financing decisions. Now you have sold off some assets from where you have realized $6. So this is what? An investment decision, that you have sold off your investments. So sale proceeds are there. Then you have raised some share capital, 2.5. Debt capital you have raised, 1. And you have paid some dividends also, 7. You have paid off some debt, 2. All of these are numbers given to you in the question. And some capital expenditure you have done, investment decisions, and some working capital payout. So you have to pay some debtors, which is not like working capital impact is not covered in the profits, right? So incremental working capital also you have to pay off. You have paid some money to buy back shares. So after considering all of these items, look at the formula, PAT plus depreciation. PAT plus depreciation plus all the items of investing and financing decisions. Then minus the items of investing and financing decisions. The free cash flow for equity is what? 39.5. Take a moment and let me know if it is fine. Please take a moment and let me know if it is fine. Yes, I'll write down that explanation here. Depreciation or your cash expense. That is why it is added back. Perfect. Others also, please confirm any item that you're not able to understand, just let me know. Till here, it's very simple. Till that, normally the way the revenue statement or the profit statement is prepared. Please take a look at this. Any item that you are not able to clearly understand. Incremental working capital. Perfect. I'll explain that to you. This needs more explanation. Let us cover it. Yes, so we can now pay $39.5 as the maximum dividend. This is the capacity that you have as a company. You may choose to pay 30, but the maximum that we can pay, Salman, is 39.5. Okay. Now let us talk about incremental working capital. It is also included. It also includes debt finance raised. Yes, we are including that because in the AFM questions, we are assuming that if they're giving it, there are no legal regulations around it. Had there been, normally it will not be given. AFM exams do not go in that much detail that there are legal constraints. They have just given it to you as an FYI. But from questions perspective, you are free to use this. That finance raised. Good point that you have raised. You're right. We are using debt finance, but that is how the logic that ACC itself has given is used. But practically it will not be. Like in India, it cannot be. Okay. All right. Now let's cover incremental working capital. Incremental working capital. So as on 1st Jan and as on 31st December year end. Okay. Debtors, stock, and creditors. Okay. So as in 1st Jan, your debtors, I'm giving a random example, not linked to this particular. First, just explaining to you the concept of working capital. Debtors is 20,000, stock is 35,000, creditors is 15,000. Okay. By the end of the year, debtors have become, and I'll also write cash balance. Let's imagine this is the balance sheet figures given to you for a company. Cash balance is 45,000. So debtors, they have now become 32,000. Stock is now 29 or 28,000. Creditors is 14,000. Okay. Now, what does it mean? Let's go line by line. Okay. Cash will complete later, but let's go line by line. Debtors. Debtors account if we were making and transactions. It will go too much in detail. How do I explain? Okay. You had a receivable. I'm taking one example, okay? Transactions during the year. Sale you have made to them of 54,000 sales. Okay. I'm considering this example in much detail. Later on, you'll understand. So debtors account. All of you would have prepared debtors account in your life. Debtors account. Can I say to balance BD brought down, it will be what? 20,000. To balance carried down, will be what? 30,000, 32,000. To sales, it will be what? 54,000. What does it mean? Balance you would have received now by cash What will it be? Sum of these two minus this. This is how the debtors account will look like. Yes. Now, what does it mean? That the change in debtors, change sales would be ultimately reflected in the PAT. Do you agree? Sales would ultimately get reflected in the PAT. It will get transferred to the PL account and it would be getting reflected somewhere in as a part of this sales part. Tell me, who had this doubt here? Gaurav, tell me, do you agree sales would be included in the PAT that is coming here? Sales, then its cost and everything. Revenue, right? It is included. Yes. Now, sales would be ultimately reflected in the PAT. Then, but I hope you agree that there has been a change in the debtors. It is not like whatever sales happened, we are finding out what? We are finding out the cash profits. In this case, entire sales has not been collected in cash, but entire sales has been reflected in PAT. Do you agree? I'm writing in very short sentences. Keep on telling me if any statement you're not able to find correct. Sales would be ultimately reflected in the PAT. We are finding out cash profits. In this case, entire sales has not been collected in cash, but entire sales has been reflected in PAT. Do you agree? This three statements so far. Gaurav, especially you, since you had a doubt in this, correct? But entire sales has been reflected in the PAT. So we need to make adjustment for sales not collected in cash. Do you agree? That is, now look at this. How much sales have you not collected in cash? 12,000. Do you agree? This is the sales not collected in cash. 54,000 minus 42,000. Do you see that this is also equals to the difference between 32,000 and 12,000? Look at these two numbers. 54 minus 42 and 32 minus 20. Both of them are same. The sales not collected in cash we see that sales not collected in cash is equals to difference in closing and opening balance of debtors. So we need to make adjustment for difference in debtors to arrive at cash profits in the absence of detailed lectures. Please tell me now, are you able to understand why we can consider So we see that sales not collected in cash, that is 54,000 minus 42,000, is equals to the difference in closing and opening balance of debtors, that is 12,000 rupees. So we need to make adjustment for difference in debtors to arrive at cash profits. So since we have already considered 54,000 as a part of revenue, I need to exclude the impact of debtors. And how am I excluding the impact of debtors? Through the adjustment of working capital. Now this working capital, it will comprise of stock, debtors, creditors, everything. So increase, always remember, this is actually your accounting classes thing I'm teaching. Remember, increase in current assets, or I'll just try to make a small table. Current assets, increase, decrease, impact on working capital. So if current assets are increasing, then it is outflow. See, you just saw that the debtors had increased 20,000 to 30,000, 32,000. It meant what? That there was less inflow, or can I say it is same as more outflow? Please tell me, is it right to say less inflow is equals to more outflow? Both of them mean the same thing. So if there is an increase in current assets, it means impact on working capital, it means it is an outflow. And if there is a decrease in current assets, it would mean inflow. Similarly, for current liabilities, if there is an increase, it will be an inflow. If there is a decrease, it will be an outflow. Working capital, what is the formula of working capital? Working capital is equals to current assets minus current liabilities. So if the information is given to you in the form of working capital, then this is what you need to consider. Please tell me now, Gaurav, is it 100% clear? Similar way you can do it for other items also, but I've just covered one particular example in detail. It will take a lot of time otherwise. But this is the gist of the discussion. Clear, everyone? Yes, Salman is clear. Others? Gaurav, you are silent. Any doubt, please let me know. If there is any follow-on question. Understood, na? Perfect. So now let's look at this. What did it say? Incremental working capital. It means that working capital increased. It will mean what? Cash flow decreased. That is why it is kept under less. If it was given as decrease in working capital, then you would have considered it as add item. Clear? Logically, we are clear. Why increase in working capital is a negative cash flow. You can consider this example. I'll remove this. So incremental working capitals, I have covered the example of debtors. Other items of working capital are what? Basically your debtors and your debtor stock and creditors. So in this way, the gist is, if there is an increase in working capital, I'll write increase to be specific. Increase in working capital. Okay. So this is how it is. Increase in working capital is a negative item. Decrease in working capital is a positive cash flow. So the cash available, that is the maximum dividend that can be paid to equity shareholders, is 39.5. Correct? Now with this extensive example, you look at the formula given in the slide. What is it saying? Operating profit, that is PBIT. From it, you reduce interest, you'll get PBT, you reduce tax, you get PAT. Any dividends that you have paid, any debt repayment, share buyback, capital expenditure, then you add back depreciation. Why add back? Because it is a non-cash. Okay. Yes, Gaurav, it is the change in working capital. Incremental is increase in working capital, and similarly decrease in working capital. Okay, you got confused, it's fine. But I hope now the concept is also 100% clear why increase in working capital is a negative cash flow, right? So add depreciation. Why? Because it is a non-cash item. Add any capital raised from shares or debt. So what you get is free cash flow to equity, that is dividend capacity. This is the maximum dividend that you can pay to the shareholders. Okay. Now with this, I have a question for you all to solve. First, as I said, make it a habit, read the requirement. Requirement is estimate and comment on the dividend capacity of CX company. You have to comment, you have to estimate. Estimate means what? Calculate, and comment on. You also have to provide a comment. Always solve it in this form and manner that you address all the requirements. Estimate and comment. So the following projected financial data relates to CX company: operating profit, depreciation, finance charges, preference dividend, tax paid, ordinary dividends paid. So the book value of CX's non-current asset last year was $200 million. This is projected to rise by $40 million. CX company is planning to repay $100 million of debt during the next year. This is the question. Now you solve it. I'm giving you 7 to 8 minutes. Solve it on your own and share your answers when you're done. Solve it in properly in an Excel file on your computer, okay? And then you share your final answer. Estimate and the comment, both. So it's 22 now. By 11:30, make sure you're done with this. So Priya and Salman have shared the dividend capacities. Where's the comment? You have to address both the requirements. How will you comment? Everyone, please share your answers. Time is up. Comment is wrong, Priya. Dividend capacity has been increased. No, that's not the correct comment. The comment would be that actually the dividend pays is X, whereas the dividend capacity is Y. It means dividend could be increased. Okay, that would be the answer. Everyone, please complete it. Share your answers. Salman, your answer is not correct. Recheck it. Priya, yours is correct. I'm giving 2 more minutes. Everyone, please share your answer. Mehak has given absolutely right answer as well as the comment. No problem. Please try again, Salman. Okay, let's have a look at the answer. There's one mistake which every one of you makes, and that is on capital expenditure. We'll discuss this. Huh? Okay. So the operating profit is 400, interest 30, right? All of this is given, interest is 30. Then PBT is 370. Then comes tax. Tax was given to us 75. Profit after tax will be 295. Correct? 370 minus 75. Preference dividend was given 15. There is some capital expenditure. We'll calculate it in a note. See, note these things, like how I'm giving. Note 1. And then I will make a note and I've linked the number from there. To you keep on noting these things, the format, how you should be writing. Then debt repayment. Debt repayment was given directly. Is planning to repay 100 million. So this was given directly. Then add back the depreciation. Depreciation, you will be adding back 60. So the dividend capacity is how much? Dividend capacity is 140. This is the final answer. Ordinary dividend is $60 million. It means dividend could be increased. Now, how to get this number? Capital expenditure. See, the opening balance was given to you 200, right? And it was given, it is projected to increase. The balance is projected to increase by 40. Then depreciation was given to you as 60. So what is the cash purchase of fixed asset? It is 100. Balancing figure 300 minus 200 is 100. This is how you would have computed. Please tell me if you have any doubts, and then I've just linked this cash purchase here. Those of you who got 240, please tell me, did you now understand? Yes? Rati? Please tell me, is it clear? Salman is clear. Most of you shared 140. I guess Rati is clear as well. Okay. So self-note, depreciation is also an operating expense. Please understand, although it is a non-cash expense, it is an operating expense. It is for the business operations only. The assets are used, right? Asset on which depreciation is charged. So don't get confused, ma'am. Is operating profit before depreciation, after depreciation? If nothing is mentioned, always consider it after depreciation, because operating profit as a term means after depreciation only. So if operating profit, that is revenue minus operating expenses given, it means that depreciation would already have been deducted. Hence, it is not reduced again. So if you are asked, if you have a doubt, ma'am, operating profit was given, depreciation, we should have first reduced it here and then we should have added it back. Now, why have I not reduced it in the first place? That is the explanation here. That depreciation is also an operating expense, and since operating profit was given to us, therefore it was assumed that depreciation is also a part of it, and it has already been deducted. Okay. So one more self note, it is given here. So profits, let's say for the year, is 200. Dividends will be paid in which year? Now please understand, dividends are always paid in the year after the closure of books. Now why was, if you might have asked me, ma'am, why was repayment of debt which will be done in the next year considered here? The answer is this only, that dividends are paid in the next year. So if it is currently 2023, when will dividends be paid? After the closure of books. And if in the next year we are going to purchase capital, or we are going to do some capital repayment, then it has to be reduced. Therefore, debt repayment in the next year will be deducted to arrive at the cash flow available to equity. Otherwise, if you do not reduce it, then you will not have the money to repay the debt. If it is not reduced, then company will not have the cash to repay the debt in the next year. Clear? So two self notes. Why depreciation is not reduced? Depreciation is not reduced. And second is why debt repayment in the next year is reduced. Okay, self notes for you. Calculation per se is this only, that dividend capacity is 140. Is everything clear? Right? Let's move to, if there's any doubt, let me know. Okay, let's move to the next slide. Okay, could you explain the debt repayment part again? Okay, so look at the question. What did it say? CX company is planning to repay $100 million of debt during the next year. Okay. Answer one of my questions, that you have calculated the profits, you have calculated the free cash flow for equity. When would you ultimately pay the dividends? So if we are in 2023 and we are closing the books in December 23, when will dividend be paid? Will it be paid in 23 itself, or it will be paid in the next year, 2024? It will be paid in the next year, Saroj. So it, now read the statement again. I'll bring it back here to Excel. Therefore, debt repayment the next year is deducted, because payment of dividend will happen in the next year. And since you also have to repay debt in the next year, if you do not reduce it, for example, the company has the policy to pay, dividend up to its maximum capacity, that is 140. Now, if you do not reduce the debt repayment you are going to make, and then the dividend capacity is 240, so you pay the dividend of 240, will you have money left to make the debt repayment in the next year? No. That is the reason debt repayment in the next year is reduced, so that you have, it is reduced so that there is sufficient cash to repay the debt in the next year after paying dividends. Understood now? Ashish, valid point that we'll be making profits in the next year also, but currently this is the estimate, and since there is a plan to repay the debt, therefore we are reducing it. As per current visibility, we are making this estimate that you should not be paying dividend more than this, otherwise there could be a crunch. Maybe you will not make profits in the first half of the year when you have to make the payment of dividend as well as the capital expenditure. Hence, it is a conservative assumption to reduce it right away. Okay. How about interim dividend? Interim dividend also you can pay. So interim dividend, you have paid certain amount. Okay. What is interim dividend? Some portion of the final dividend which is paid, you have paid during the year itself. Final dividend is what you need to pay overall to the shareholders, right? So what is the question then? How about the interim dividend, meaning what? What do you want to ask? They'll not ask. Interim and final, they'll not ask anyways. And even if interim dividend is to be calculated, the formula will be same only. You will be considering all the inflows, all the payouts with respect to the investment and financing decision, and then find out the dividend. Then that will be reduced. Yes, this debt repayment will still be reduced. Okay. All right, let's come back to the deck. Now, dividend policies, very, very important. What type of policies can a company adopt to pay off its dividends? Okay, that is what we are going to cover here. So, having considered these factors, companies will formulate and communicate their policy to ensure that shareholders have realistic expectations. Okay, so whenever you are investing in a company, you have a certain expectation that this is the amount of dividend that we will be receiving, right? So what would be that amount? What should be the realistic expectation at the shareholders' end? That is dependent on the dividend policy a company is following. And normally, companies follow a consistent dividend policy year on year, so that the shareholders have a fair expectation of what they are going to get as dividend for a year. Because for a lot of people, dividend could be a substantial source of income, and definitely they would be planning their lives around it. So, having considered these factors, companies will formulate and communicate their policy to ensure that shareholders have realistic expectations regarding the dividends they are likely to receive. Now, what could be those policy? Number one is constant payout ratio. Logical, but can create volatile dividend payments if profits are volatile. Now, what does it mean? Constant payout meaning a certain percentage. Okay, let's come to okay. Example, every year 30% of of I should write FCFE. Example, 30% of FCFE is paid as dividend every year. So constant payout is a fixed percentage of the free cash flow that you are getting, that you are going to make as dividend payment. But there is a problem. The issue is that if profits are volatile, that means they fluctuate a lot, then dividends will also fluctuate. Right? If profits are volatile, then dividends will also fluctuate. That is the concept of the constant payout dividend. Okay. Next, stable growth. Set a level that signals the growth prospects of the company. What does this mean? Stable growth. Fixed growth percentage on previous year dividend. Okay. Example, 5% growth over previous year dividend. Do you think the shareholders will have a fair expectation if this policy is followed by the company? So, shareholders can fairly estimate their annual dividend every year. Correct? Next. Next is what? Residual policy. Only pay a dividend after all positive NPV projects have been funded. So you're not following any policy. Whatever is left over residual policy after all positive NPV projects have been exhausted, leftover money would be paid as dividend, leads to highly volatile dividends. Now look at all of these three types of policies. Tell me which one do you feel is the best with respect to a dividend policy? What do you think? What do you think is the best policy with respect to a dividend? Stable growth. Mostly it will depend. Yes, you're right, Saroj. In a way, it will depend on the type of the company. If it is a stable company, then even constant payout ratio is suitable for it. Okay, so mostly in a general way, we can say stable growth is fairly the best policy because it tells the investor what to expect, and it also reflects the growth prospects that the company is growing over time. Okay, so these are the three dividend policies. Now, next topic is methods of distribution of earnings. If there is any doubt, let me know. Okay, I'm moving to the next one. Topic. It's fairly easy, this topic. Next topic is methods of distribution of earnings to shareholders. So you would have, heard that normally in a normal scenario, break break sometime. Otherwise, the second session becomes too long. Ashish, around 12:15, we'll take the break. All right. So I was saying that normally the dividends are paid in cash, right? You would have, if you are already invested in a dividend-paying company, you would have received money in your bank account directly. But that is not the only way to pay money to the shareholders. You can pay money, or you can distribute your earnings, the FCFE, to the shareholders in different ways, and that is scrip dividends and share buybacks. So scrip dividends is what? A company will sometimes offer a scrip dividend. That means rather than paying cash to the equity shareholders, company pays them extra shares. Okay, so if the amount that they want to disburse to you as a dividend is 10,000 rupees and the share is trading at 2,000 rupees, so they will give you 5 shares instead of cash. So your demat account will get credited with 5 yes, bonus shares. I was coming to that. So it is like 5 shares are getting credited to your demat account. It is also known as bonus shares. Okay, scrip dividend is nothing but bonus shares or extra shares. Compared to a cash dividend, a scrip dividend boosts the company's cash flows. See, because how will bonus shares boost the company's cash flows? Because in case of cash dividend, cash outflow happens. But in case of bonus shares, cash outflow does not happen. And this may benefit shareholders if the cash is reinvested in positive NPV projects. So instead of paying money to the shareholders, the company will retain the cash and reinvest it in positive NPV cash flows, NPV projects that could not otherwise have been financed. An enhanced scrip dividend, it is a part of scrip dividend only. An enhanced scrip dividend involves giving the shareholder a choice over whether to take cash or shares, but offering a generous amount of shares so that it is likely that shareholders will choose to take shares instead of cash. So scrip dividend is bonus shares. Enhanced scrip dividend is you give the shareholder a choice between cash and bonus shares, but the value of bonus shares is normally kept to be higher than the cash payout, so that a person is normally attracted towards shares rather than cash. Okay, so that is the meaning of enhanced scrip dividend. Scrip dividend is what? Giving shares instead of money in dividends. That is also known as bonus shares, right? Now, another way to reward the shareholders instead of paying cash dividend is share buyback. Have you heard of companies buying back shares? Can you give me an example? Can you give me an example of a company which buys back shares regularly? Yes, TCS is one of those companies which buy back shares very much regularly in the market. So that is a way to reward the shareholders only, right? Like you have been our loyal shareholders, so instead of paying them dividends, they are buying back their shares at a higher price than the market offers. Okay, so that is an example. TCS. As an alternative to cash dividend, a company can choose to return significant amounts of cash to shareholders by means of a share buyback. The bought back shares are cancelled. Okay. Um, you cannot pick and choose the shareholders to whom you're going to offer the buyback. So your point may not be valid, to avoid troublemaking shareholders. But if the shareholder is having a very big, uh, a majority, not majority exactly, a big shareholding, and you want to exclude them, then you give them that lucrative offer so that they take the money and go back. That's what you're saying, right, Salman? So in some cases, it can apply. But majority of the cases, like if you're talking about, big listed companies like TCS, it's about rewarding their general shareholders, right? Like you take your money, we are giving you a better rate than the markets. But tell me one thing, is it a wise choice to tender shares in the buyback? Is it a wise choice to tender shares in the buyback? Think about it. See, company is planning to give you higher money as in is the market price. What does it mean? The management of the company has hopes that the share price will only increase over time. Then only they're willing to give you that extra money. Otherwise, who will give extra money? The management believes that in the long run, the share price is going to increase a lot. So they opt to give you that extra amount over the current market price, but they know in the long term it is only going to benefit the company. That the share, the percentage control of the founding members, it increases, and also the shareholders get rewarded. Whoever wants immediate money, they can get that. Okay. So the to answer the question, is it wise? Normally, if the company is reputed, then you should avoid the buybacks, because it shows that the management has a lot of faith in the company and therefore they are willing to offer higher price. Otherwise, they would not have offered that higher price. All right. So, as an alternative to a cash dividend, a company can choose to return significant amounts of cash to shareholder by means of a share buyback. Example is TCS. Now, what are the advantages of share buyback? So it avoids increasing expectations of higher dividends in future, which may be a problem if dividends are increased. More the number of shares, more is the dividend payout that will happen in the future. So to avoid paying higher dividends in the future, a company can choose to buy back the shares so that for once and for all, at least those many number of shares have been cancelled. It provides disaffected shareholders with an exit route. In this case, it is a defense against a takeover. So, like you were mentioning, Salman, but this is a little different. It is saying that, those shareholders who are not getting an exit route, they are not able to tender their shares in the open market, they can opt for this. It provides disaffected shareholders with an exit route, right? Third is it is taxed as a capital gain, which may be advantageous if the tax on capital gains is below the rate used to tax dividend income. Share buyback is like a sale of shares, no? So it will be taxed as capital gain, whereas dividend income is taxed as other income. I know there are exemptions in India, but generally speaking, if the tax on capital gain is lower than the tax on income, then opting for share buyback could be beneficial, right? Next is if the shares are undervalued, that means the current market price, the company may be able to buy shares at a low price, which will benefit the remaining shareholders. Fewer shares will improve EPS and DPS ratios because the shares will get cancelled. So, in a way, the company will be able to offer higher EPS and DPS eventually. Okay. So these are the advantages of share buybacks. It avoids increasing expectations for dividends in the future. It provides exit route to the disaffected shareholders. It is taxed as a capital gain. And if the shares are undervalued, this can benefit the shareholders who have not tendered their shares in the buyback, as it will lead to improvement in the EPS and DPS of the company. Right? These are the advantages. Now, another type of method or another method to distribute earnings to the shareholders is special dividend. Don't get confused between scrip dividend and special dividends. They are different. Okay, what is scrip dividend? Bonus shares. Now, let us understand what is special dividend. Another way of returning significant amounts to cash to shareholders is by way of special dividend. A cash payment far in excess of the dividend payments that are normally made. This has a similar effect of returning significant amounts of cash to shareholders, but unlike a share buyback, it impacts all the shareholders. Can you tell me a commonly used term for this by reading the explanation? This is something you already know. It is interim dividend. It is interim dividend. So you have paid, as per your past trends, you have paid the final dividend, but you want to reward the shareholders more. So you plan and announce interim dividend. That is nothing but special dividend. Now read the statement again, keeping interim dividend in mind. Another way of returning significant amounts of cash to shareholders is by way of special dividends, a cash payment far in excess of the dividend payments that are normally made. Normally made dividends are what? The final dividends. Now, so this has a similar effect of returning significant amounts of cash to the shareholders, but unlike a share buyback, because share buyback, only selected people will tender their shares in the buyback. But unlike a share buyback, it impacts all the shareholders because interim dividend will be paid to all. Is it clear? Is it fine? Everyone, please tell me. Saroj says yes. Others? Yes? Okay. Now, this is a very simple topic. The different types of stakeholder groups. So the decisions are over. Financing decision, investing decision, dividend decisions, and the risk management. That's over. Now, this is another part of this chapter, and that is about ethical issues. Buyback of shares, who will have the ownership? So the shares which are bought back, Salman, they are cancelled. They become null and void. So in a way, the existing shareholders' percentage control increases. Although it's not they are taking back the shares. The shares are bought and cancelled back as if they were never issued. So the percentage of shares which the remaining shareholders are holding, it will obviously increase, na? Got it? Okay. So the next topic is the ethical issues. It is, a new and bubbling topic in AFM. So some part of it was there, but a lot of changes have been introduced in this, and therefore it is extremely important from exam point of view. Okay, so let us understand. Now, the key financial objective for a business is to create wealth for its shareholders. That means what? The wealth maximization principle. For financial strategy to be successful, it needs to be communicated and supported by key stakeholder groups. Now, I am making a statement. Please tell me, is it true or false? All shareholders are stakeholders, but all stakeholders are not shareholders. True or false? It is true. A business has multiple stakeholders, and out of which one of them is shareholder group. There are other important stakeholder groups as well, and they are classified into 3 categories: internal, connected, and external. Now, what are internal stakeholders? Imagine them like people who sit inside the company's premises. They would be the managers of the company, the employees of the company. These are also very critical stakeholder groups, managers and employees. Next, we have connected shareholders. People who are not sitting inside the company's premises, but they're very closely connected to the company's business. And who are they? Shareholders, banks, customers, suppliers. So they're very closely connected. Although they're not sitting inside the company's premises, but they're very closely connected to the company. The third category of stakeholders is external. They're not very closely connected to the business. And of course, they're not sitting inside the company's premises. Who are they? Government. Is each and every business very closely connected to the government? No. So government, pressure groups, the different types of, like you can say, trade organizations and all, they come under the definition of pressure groups. So government, pressure groups, local communities, the neighboring people of your premises, they will be coming under the definition of external stakeholders, and within it, local communities. So where a strategy creates a conflict, sometimes it may so happen the interests of one group of stakeholders conflicts with the interests of the other stakeholder groups. So where a strategy creates a conflict between the interest of shareholders and those of other stakeholder groups, then this can create ethical issues. Now, whose interest should be prioritized? That is what the problem is. Sometimes, there is a conflict which happens, whether to pursue shareholders' interest or whether to pursue customers' interest or whether to pursue employees' interest. So where a strategy creates a conflict between the interest of the shareholders and those of other stakeholder groups, then this can create ethical issues which need to be carefully managed. You may be required to analyze this as a part of an exam question, which will require you to use your common sense to consider the impacts and how the stakeholders may react. So they will give you a scenario whereby a conflict is going to arise between shareholders and, let us say, employees of the company. Now, you as finance managers have to take an action which is going to, pacify both of them in a way. You have to prioritize something. So that is where you're going to use your common sense mostly. Okay. So complete the following table with ideas of potential issues. Now, this is very subjective answer, no right or wrong answer. It's on you to ponder upon. Complete the following table with ideas of potential issues in key areas of financial management. Basically, in investment, between whom could there be a conflict and what could that conflict be? Okay. Similarly for financing, dividend policy, and risk management. So you have to talk about the ethical considerations you need to keep in mind. Between whom could there be conflict, or how, what that conflict could be, like that. So think about it. I'm giving you some time. It will take some time to develop for each one of them. 2 minutes for each part. So basically 8 minutes. It's 12:08. Quickly close it by 12:16. Okay. Quickly close it. What could be the type of conflicts that could arise in each of these decisions? All right. Share your answers when you're done. Yes, so time is up. Anyone who has completed? Overvaluation. Okay. Good, valid point, Salman. Overvaluation of acquiring entity, na? Of the target company, basically. Yeah. Good point. The conflicts are not coming out. Priya, like for in your example, I can't see conflict. And Gaurav, yours also I'm not able to see the conflict. You're talking about some sort of a misdoings, which is not the intent. The intent is like what type of conflicts could arise between the different stakeholders. Others, anyone else who has tried? Let's have a look at the model answer. Everyone, please take a look here. Okay, let's first talk about the investment decisions. Now, investment decisions here, there could be a conflict with respect to fairness of wages and salaries. This conflict will be coming from whom? Employees. That we are being underpaid. The working conditions are not good. Training and career development is not happening. Why? Because the money is being invested somewhere and not being invested in us as employees. Okay. Next is potential impact on the environment, which Salman's also mentioned, the ESG conflict. So potential impact on the environment, the local communities could be feeling that the company is not investing in environment friendly machineries. This is a conflict. Then third is bribery of government officials. This is conflict with respect to what type of bribery you're giving. So government as a stakeholder and the company's management. What if the company gets involved in some sort of unethical practices because of this? So bribery is a conflict which could arise. Then failing to invest because bonuses are paid on short-term share performance. So you are giving bonus to the employees on short-term performance rather than their long-term views and performance. So this will lead to a conflict in shareholders and the employees. The shareholders will feel that the employees are working towards short-term goals only. Next, overpriced takeovers. That the managers are giving excess money to the target companies. This will lead to deterioration in the wealth of the acquiring companies' shareholders. So overpriced takeovers indicate that managers are focused more on empire building, that they're more focused on living up to or increasing the legacy of themselves rather than on shareholder maximization. Why? Because if you are taking up overpriced acquisitions now, it leads to deterioration in the wealth. This is not something which should be done. These are all examples of conflicts which could arise between shareholders and some other stakeholder, right? Next, we have financing. Now, financing means what? Sources of finance. Now, a bank lending the company money may have an unethical profile. So, from where you are taking the money, if that is not ethical, then this could put the company's business into jeopardy. Next is tempting to suppress bad news at a time that finance is being raised. So, when you are about to enter the stock market, you are hiding some, internal mishappenings so that you get the finance. Otherwise, if a bad news is out, then you will not get the finance. So, this is a conflict in ethical reporting. These are examples of ethical issues. Next, dividend policy. It may be at the expense of providing quality products, that you're not providing quality products to the customers rather than you are giving money to the money as dividends to the shareholders. So this is an ethical issue leading to a conflict between shareholders and customers. Next, risk management. An example could be neglect of risk management in order to hit profit margins. So you're doing a very risky business. So just to hit the profit targets, you are neglecting risk management. Now, directors pursuing diversification strategies to protect their own positions when it is not in the best interest of shareholders. So, the directors are pursuing a diversification policy of risk management. When you diversify the investments, the risk reduces, no? So, they are following this strategy, but ultimately it is at the expense of the wealth of the shareholders. Again, this is an ethical issue leading to conflict between directors and the shareholders, right? So these are the 4 areas of financial management and the conflicts that could arise. What about mining company? Okay, in this type of examples, now avoid giving industry specific points. Try giving generic points which could apply to any industry, because this question did not give you the scenario of a mining company. If it was given in the scenario of a mining company, then your point would have been valid. Okay. So avoid giving, industry specific examples in a generic question, and vice versa. If it is a specific industry example, give specific industry examples only. So both of them, generic question, generic answer, specific industry specific question, industry specific answer. That is how it should be. Are all the points clear? Any example which you could not understand? Anything? Please tell me. Any point you want me to explain further? Take a look at it. No hurry. Just let me know if you're clear. Clear? Okay. Perfect. Then let's do one thing. Let's take a break now. It's 12:25, 20-minute break. We'll catch up at around 12:45. Okay, and then we'll start off this ethical. We'll continue this topic. All right, refresh yourself and then be back after the break at 12:45. Hello everyone, welcome back from the break. Let's continue our discussion on ethical issues. Okay. So ethics and stakeholder conflicts. Different types of conflicts that can arise between shareholders and the different type of stakeholder groups, including customers, directors, right? So ethical issues often arise from a conflict between the needs of different stakeholder groups. Questions which include ethical considerations are likely to be of practical nature and are more likely to require you to give a practical advice on a fair resolution of stakeholder conflict. Most commonly, this will be a conflict between shareholder and the needs of another stakeholder, but other conflicts may also need to be managed. Other conflicts meaning conflicts between maybe, let us say, customer and directors. So most common examples are conflicts between shareholders and some other stakeholder group, but there can be examples of conflicts between the different stakeholder groups as well. Okay. So what are the examples of stakeholder conflict? Let us understand. First of all, directors and shareholders. Directors may be more risk averse than shareholders because a greater proportion of their income and wealth is tied up in the company. Now imagine you are the director of a company. So you are full time working in that company. Your sole source of livelihood is that company. Whereas imagine now a shareholder. The shareholder can easily diversify his investment. He can put his money in different companies. So directors may be more risk averse. Directors will not want to take more risk. Why? Tell me now. Directors will not be willing to take more risk, or they will be risk averse. Why? I just gave you the basis of the reasoning. Tell me. Very basic reason. Because no, because director's sole source of livelihood is in that company, and if due to taking risk anything happens to the company, their source of livelihood can get affected. That is why directors will not be willing to take much risk. Whereas shareholders will be like, I have put my money in multiple companies, my risk is already diversified. If one company fails, some other company will compensate for it. But for the directors, it is not the case. Their entire livelihood is dependent on just one company, and they will not want to take more risk in that case. So directors may be more risk averse than shareholders because a greater proportion of their income and wealth is tied up in the company that employs them. Whereas many shareholders will hold a diversified portfolio of shares. They can take risk. If one company underperforms, another company will overperform and offset. The gains and losses will get offset. So also, directors may focus their decision making on benefiting their own division instead of the company as a whole. So if the hierarchy of the company is such that there are directors for different divisions, even within the company, directors will want to improve the performance of their division rather than thinking of the company as a whole. They will be focused on their division's performance only. So the relationship, and of course, this is not good for the company. No? The shareholders will not want that. The relationship between management and shareholders is sometimes referred to as an agency relationship, in which managers act as agents for the shareholders, because ultimately the money is of the shareholders. No? So managers are considered to be the agents, the hands on the deck who are managing the company. Money has been put by them, but they're not good at managing. So they employ managers. So managers are considered as agents for the shareholders. The goal of agency theory, it's very important, remember this term. The goal of agency theory is to find governance structures and control mechanisms that minimize the problem caused by the separation of ownership and control. What it is saying is, see, ownership is with the shareholders, control is with the directors. So there is a separation. Ideally, like now, imagine for a sole proprietorship firm, owner himself is the manager also. So his decisions will be aligned as in both the scenarios, like what is the best way. But in case of a company where ownership and control are separated, there can be conflicts. Okay. So the goal of agency theory is to find governance structures and control mechanisms that minimize this problem. Now, the company is structured in such a way that such problems are reduced. All right. That was about directors and shareholders. So, what is agency theory? What is agency theory? Is everyone back from the break? Why is there so much silence? What do you mean by agency theory? Tell me. Let me read what all you have shared. Parul says shareholders or are the owners who have appointed directors as agents. Okay. Agency theory is the relationship between agent and the principal and management of the company. The problem between shareholders and management that the agents work in. Okay. All right. All right. Then it's clear you have understood. So there is separation of ownership and control, and the management has to work to ensure the rights and interests of the owners, that is the shareholders, is uplifted. Okay. Next. Conflicts between different stakeholder groups. So there can be conflicts. Some shareholders might want short term, their preference would be for short term dividends, whereas some shareholders will want capital gain in the long term. So this could be a difference. The second category of shareholders, they will want the dividend to be reinvested rather than being paid to them. So they want long-term capital gain from the company, whereas some shareholders might want dividends in the short term without waiting for the capital gain to come. Okay. Then conflicts can arise between shareholders and debt holders. Debt holders may be more risk averse. They wouldn't want to take risk now, because ultimately, whether or not the company takes risk, they are going to get assured returns. If the company takes risk and it goes south, then their interest payouts come at risk. If the company takes risk and it goes to the north, that means it performs well. Who will get the benefit? Shareholders. So debt holders, they are risk averse, whereas shareholders are risk takers or risk seekers, because it is only shareholders who will benefit if risky projects succeed. Right? Next, conflicts can arise between shareholders and staff, customers, or suppliers. So pursuit of short-term profits may lead to difficult relationships with other stakeholders. For example, relationship with suppliers and customers may be disrupted by demands for changes to the terms of trade. Can you give me an example of terms of trade? The credit period. Earlier, the credit period which was being given to the suppliers was 60 days. Now it is being reduced to 30 days. So, the shareholders, they want profitability. So they are reducing the working capital cycle. So pursuit of short-term profits may lead to difficult relationships. Why now? The suppliers will be like, I'm not getting good terms from you. I look for some other customer for my product. So in this way, pursuit of short-term profits can jeopardize the relationships with other stakeholders like suppliers and customers if you are changing the trades, the terms of the trade. Employees may be made redundant. That means they may be laid off. Typical example is Twitter. When Elon Musk took over, he laid off the staff to reduce the cost. These policies may aid short-term profits, but at the expense of damaging the long-term relationships and consequently damaging shareholder value in the long term. Okay. Next is shareholder and external stakeholders. Example would be environmental impact. If your company is creating pollution, air pollution, noise pollution, so that would be the conflict. The shareholders will say, we have to do the business to make money. Environment activists say, you're damaging the environment. So there could be such conflicts between shareholders and other stakeholders. Is it clear? Yes, perfect. Let's do one thing. Let's try to summarize this in the small table in Excel. Category of stakeholders and type of conflict. So directors and shareholders. Directors may be risk averse, whereas shareholders may be risk takers. Right? This is the conflict in the way they are going to deal with the problems. Correct? So managed through agency theory. All right. Next type of conflict was between shareholder groups. Within shareholder groups, some want short, some want dividends, some look for long-term capital gain. Next, shareholders and debt holders. Debt holders may be risk averse, whereas shareholders may be risk takers. Next, shareholders and staff. Employees may be laid off to cut costs. Shareholders and suppliers, oblique customers, suppliers, customers may be impacted due to change in terms of trade. Example would be credit period, right? Next, shareholders and external stakeholders companies activities may cause pollution, environment impact. Right, so I've just summarized it for you, very short, the 2 slides that we discussed. Okay. Now, a framework for developing ethical policies, completely new in the syllabus. All right. So let us understand what is the framework for developing such policies which are ethical for the company. In principle, an effective framework will help to analyze some ethical issues in exam questions. It will also be appropriate to apply your common sense to create practical solutions to the ethical problems that appear as a part of the exam question. So therefore, you have to exercise common sense when you're dealing with ethical issues in questions. So what is the framework? First of all, establish stakeholder concerns. Okay, so what that means is assess impact of activities, whichever activity is causing stakeholder conflict, assess the impact of such activities on different stakeholders and ensure that solutions are researched to try to meet the needs where possible. So if there are conflicts arising between the interests of different stakeholders, develop solutions which meet the needs of whoever possible. Ethical concerns should then be reported to an ethics committee to ensure that the board is aware and can take action. So wherever conflicts still persist, it should be reported to the board for corrective action. Second step is understood by everyone. So issue a code of conduct. Those of you who are working will know that each one of the companies have their own code of business conduct. Like employees will not accept gifts beyond 10,000 rupees, for example. Okay, employees will maintain decorum, discipline. They will ensure they are accepting towards diversity and integrity. So all of these code of business conduct, they should be understood by everyone. Issue a code of conduct outlining key ethical values, integrity, honesty, shows commitment from senior management. If the tone at the top itself is like, who cares about the ethics, we'll do whatever type of corruption we want to do, it will set the wrong tone and benchmark for people in the lower organization. And then this ensures that the staff, whatever actions they take, it is guided by such ethical principles. This is the second step in preparing ethical policies. Third step is introduce safeguards to reduce threats to an acceptable level. What it means is policies and procedures. So if the threat arises, there is a proper safeguard, like an antivirus for your laptop. It is to safeguard the laptop from threats, right? Like viruses. So there should be policies and procedures which safeguard the company from external threats. Executive bonus schemes could be revamped to include ethical measures. So the executives, the senior management will get the bonuses only if they comply with ethical measures or ethical policies. Greater powers to the risk management function. The team which is managing the risk, they should be given more powers. And whistleblowers hotline to ensure confidential responses to concerns. So if someone is witnessing an ethical issue in front of them, They should have the liberty and the freedom to remain anonymous and report the issue without any fear of retaliation. Only when you are implementing these 3 steps, then you can create a framework for developing ethical policies. Otherwise, your policies will not be implementable, or they will not be executable. So these 3 steps need to be followed to ensure that the framework is, there is a quickly revise. What it says is, number 1, establish stakeholder concerns. What each activity has an impact on different stakeholders. Assess it. Develop a solution which addresses maximum of the needs. Whatever unresolved ethical issues are there, it should be reported to the ethics board. Second step is that the company's fundamental principles should highlight ethics. There should be a code of business conduct which highlights integrity. Then third is, there should be policies and procedures which safeguard the company against threats, so that even if the principals are not able to defend them, there are policies and procedures which will defend the company in case of a breach of ethics. Like a whistleblower policy without any fear of retaliation, and that is possible only if the person reporting the ethical issue is kept anonymous. Okay, see, because ultimately if you're staying silent, that is also a crime. When you're seeing a crime happening and you're staying silent, that is also a crime. So you need to provide these tools to the employees to report ethical issues. Is it clear? You all might be thinking AFM was supposed to be practical, ma'am. Why are we not doing any practicals? First few chapters at least. I think first 2 chapters primarily they are theory. And then we'll get in the groove of practical questions. Is it clear? Let me know if any point that you could not understand. Salman is clear. Clear. Perfect. Let's move ahead. Governance. What does governance mean? Have you heard this term before? Good governance is when corruption is curtailed. Okay, the checks and controls in the company are such that corruption cannot come up. Unethical practices can't be undertaken. So safeguarding against the risk of unethical behavior may also include the adoption of a corporate governance framework of decision making that restricts the power of executive directors and increases the role of independent non-executive directors. You would have heard the term executive directors and non-executive directors. Executive directors are responsible for managing the business. Non-executive directors manage and monitor how executive directors are performing their duties. So safeguarding against the risk of unethical behavior may include the adoption of corporate governance framework of decision making that restricts the powers. Executive directors should not think that they are gods. So there should be a committee which restricts the power of executive directors and increases the role of non-executive directors who are responsible for just monitoring the duties of the EDs, the executive directors. Okay. In some countries, this can include a non-executive supervisory board of non-executive directors, with representatives from the company's internal stakeholder groups, including the finance providers, employees, company's management. It ensures that actions taken by the board are for the benefit of all stakeholder groups and to the company as a whole. See, ultimately, executive directors are responsible for taking decisions. Whatever the company does is actually signed off by the executive directors. If there is no control on the power of the executive directors, they will do whatever they want to. And all of the decisions will be for their own good. So there is a group of non-executive directors whose compensation or whose remuneration is independent of company's performance. Why? Because their job is only to monitor the non-executive directors. So they will just look up what they are doing. Is their actions sustainable? Is it, good for, or is it for the benefit of all the stakeholders, including employees, customers, suppliers, government, environment? Very, very important is governance. And what does it mean? Governance means safeguarding against the risk of unethical practices, for which a non-executive board may be established to monitor the duties of executive directors. Please take a look and let me know if it is fine. Here, I have an example for you, which I'll put in this slide only. Give me 1 second. Example is from Infosys. Let me put it and then discuss it with you. Yeah. So Infosys, the example is from Infosys. So in 2017, Infosys faced a leadership crisis, and the role of non-executive directors became pivotal in restoring confidence and improving governance. So the board, led by non-executive chairman Nandan Nilekani and independent directors, undertook various initiatives. And what were the initiatives they took? Board reconstitution. The board was reconstituted with a majority of independent directors to strengthen oversight and independence. There was a leadership crisis with respect to the actions taken by the executive director. So this board was reconstituted. Second, investigations and reforms were done. Independent directors led internal investigations into allegations of corporate governance lapses. Their recommendations led to reforms in governance practice, including changes in CEO salary. Okay, such is the power of non-executive directors. Then enhanced communication. Non-executive directors played a crucial role in improving communication with shareholders and stakeholders, providing clarity on governance measures and the company's commitment to ethical business practices. So there was proactive communication with the different stakeholders to reinstate the faith which they had in companies' ethical business practices. So in this example, non-executive directors, particularly independent directors, played a pivotal role in enhancing corporate governance at Infosys during a challenging period, demonstrating their significance in upholding transparency, accountability, and shareholder value in Indian companies. Right? This example helps you to understand the importance of non-executive supervisory board. Are we clear? So what is the role of non-executive directors? To ensure the duties of the executive directors are being performed properly. Okay. So you can refer to this example later also with respect to emphasis. All right. Next topic is sustainability. Have you heard this term sustainability before? If yes, tell me, what do you mean? What do you mean by sustainability? Sustainability reporting. Okay. What do you mean by sustainability? No one knows what is sustainability. Okay, let's discuss it. So sustainability, you would have heard it in your EVS classes, maybe, environment sustainability. That you leave the world in a good position for the generations to come. Like the way you are enjoying the earth's resources, the same way the coming generation can also enjoy it. That is sustainability, to continue to flourish in the same form and manner. So sustainability is not a fixed state of harmony, but rather a process of change in which the exploitation of resources, that is the usage of resources, the direction of investments, the orientation of technological development and institutional change are made consistent with future as well as present needs. So sustainability is not about, we are very harmonious with respect to all the relationships, but it is a way, it is a process of change in which the resources are used, the investments are done, the technological developments are done, and institutional, like the big changes are made, keeping in mind that how they will impact the future generation, not just the present generation. So sustainability is about how your actions, in simple terms, how actions impact the future along with the present. Very simply put, that is sustainability. Okay. 1 second. Yep. Next is corporate sustainability. What is corporate sustainability? A business approach that creates long-term shareholder value. Again, you have to think from long-term. Wherever you see the term sustainability, think from the long-term perspective. Now it is talking about corporate sustainability. So it is talking about creating long-term shareholder value by embracing opportunities and managing risks from economic, environmental, and social developments. Okay. Next is, so corporate sustainability is about how the business actions, how the activities taken up by the corporates, they are embracing the opportunities in the long term by managing the different aspects of business. Okay. Sustainable development is development that meets the needs of the present without compromising the ability of future generations to meet their own needs. This is something which you would have read in your EVS classes in class 8 or 9. That how do you meet the needs of the present so that the earth remains in a way which is which provides for the resources of the future generations. So sustainable development. Okay. And sustainable finance is what the process. Now comes the term, which is the recent amendment, the process of taking environmental, social, and governance considerations into account when making investment decisions in the financial sector, leading to more long-term investments in sustainable economic activities and projects. So when you are opting for finance, it should be taking environmental, social, and governance aspects into account. Okay. So while you are making investment decisions, these aspects What will be the environmental impact? What will be the social impact? What will be the governance impact? What is governance? Governance is something we have just covered. What is governance? That the executive directors perform their roles and responsibilities rightfully. So there is a non-executive board looking after their performance. How it should be considered ESG? Meaning, I didn't understand, Ashish. I didn't understand your question. How we should consider ESG. So there are slides. We are going to cover it in a lot of depth. It's a new topic now, so a lot of things are going to be covered. Okay. So sustainable finance, it is talking about how when we are investing, we make use of or we keep in mind the environmental, social, and governance impact. All right. So these are the important definitions. So you don't have to memorize the definitions, but be aware about these terms. No one will ask you what is sustainable development. But the question could be explain sustainable development in the company's scenario, whichever is given to you in the question. Okay. So that way you need to be clear in its meaning. Like, what do you understand with respect to the sustainable development and also the sustainability concepts, be it the sustainable finance, right? So you need to be aware about these aspects. It also includes climate finance. Climate finance will be a part of environmental finance. Sabah. Okay. All right, let's go deep dive into these concepts now. So, sustainable development. What did we understand by sustainable development? That development that is happening today should be done without compromising the ability of future generations to meet their own demands. Okay. So, examples are using or adapting existing facilities rather than building from the scratch. You know, how do you do sustainable development? You revamp, you renovate existing facilities rather than building a new facility altogether. Okay. Next, environmentally friendly building and design. So you would have heard about companies being constructed in a way that it remains warm by the sunlight in winter, I mean, in cold countries. The buildings do not use heating equipments as much because of this. Correct? So, yes, Apple headquarters. So, they are constructed in such a way that the heating consumption, because ultimately heaters they work using electricity, and electricity has a lot of environmental impact. So, the building and design should be such a way that it is environmentally friendly. You are consuming less resources of the environment. Correct? Next is minimization of adverse effects on nearby residents. So recently, there was a show also on Bhopal gas tragedy. It typically talks about how the management of the Union Carbide company didn't give a damn about what the residents go through. Correct? So it was not sustainable development, and whatever tragedy happened. So whenever you are developing something, you know, some sort of a new business or you are undertaking a new project, there should be, you know, an assurance that the adverse effects on the nearby residents is minimized. Okay. Next example of sustainable development is protection of native vegetation. The forest should be cut less, flora and fauna should be preserved, right? So protection of native vegetation, you know, like the Amazon forests. A lot of the, you know, nearby neighboring countries, they ensure that the forests are not cut. Although there has been a lot of deforestation already, but there is a, you know, greater sort of a, I mean, say awareness, I would say, to not cut the forest because of the negative environmental effects. So all of these are being talked about, that how can protect the native vegetation. Next is minimization of non-renewable waste with recycling encouraged. Of course, so you minimize the non-renewable waste and work towards recycling it. So a lot of grades of plastic have been banned because they can't be recycled also. So they have been banned, and the government is promoting use of cotton and cloth bags rather than plastic bags, or in fact even the plastic is of higher quality. So that is about minimization of non-renewable waste. Next, minimization of non-renewable energy use. Thermal energy, it's non-renewable. So the government is promoting the use of solar energy, tidal energy. So example, replacing coal, oil and gas with solar, wind and other renewable sources. This is an example of sustainable development. Next is minimization of pollution or cleaning up if it exists. A lot of the plants, they are equipped with pollution equipments, so that whatever air is discharged or whatever polluted water is discharged into the nearby surroundings, it is cleaned up so that the negative adverse effects can be minimized. So there were a lot of news at one point of time that wastewater being discarded into river bodies is affecting the health of the residents nearby. So all of these things are being looked at by the government, so that there is sustainable development, the resources are available, the coming generations are healthy. So that is what it is about, minimization of pollution. Yes, oil spill is a good example. If there is an oil spill by a company, the company is instructed to clean it up. You can't just get past it. You have to clean up the seas and the oceans if an oil spill is happening, right? Next is construction on brownfield sites. That is, those previously used as industrial commercial sites, leaving greenfield land untouched. Whatever the vegetations are, you leave them as it is. Whatever sites were being used for industrial and commercial purposes, only they are used. Okay, so construction on brownfield sites, meaning you avoid use of green lands, and whatever lands have been used and contaminated by industries, only that is allowed to be used further by industries. Okay, so I know it's very theoretical, but can't help it. Some examples. If there is any doubt, just let me know. Very simple as a concept. Any viewpoints or anything which you could not understand, please let me know, or else we'll move to the next slide. Clear? Gaurav and Salman are clear. Others? Anirudh, Ashish, Mehak, Parul, Priya, Rati, Saroj. Clear? All right. Perfect. Perfect. Now let's come to ESG investing, the hot topic. ESG investing. It is also called sustainable investing, impact investing, ethical investing. A lot of different terms are there. How ESG is referred to. It prioritizes ESG factors. What are ESG factors? Quickly tell me. What are ESG factors? Fastest fingers first. Environmental, social, and governance. Perfect. So ESG investing, it prioritizes the ESG factors and performance alongside the profits of an organization. So no longer you have to just prioritize the profits, you also have to prioritize the impacts on environment, society, and governance of a company. It considers both the material risk and opportunities business face related to these factors. It prioritizes a long outlook over short-term profits with high environmental and social costs. You have to think from the long term. long-term sustainability of business practices, rather than just looking at, just do it, it's short-term profits. No, you have to think from the long-term perspective, how each activity is creating an impact on environment, on society, on the governance structure of a company. Okay. So this style of investing aims to preserve rather than deplete the environmental and human resources businesses depend on while still making profits. So profits are not deprioritized, but other factors are also prioritized. And what are those other factors? ESG. So a review of ESG issues provides a deeper, more penetrating risk analysis, and systematically considering ESG issues will likely lead to more complete investment analysis. Right, Ashish? So you wanted to know like how we will do investing with ESG. We are going to cover that now, and better informed investment decisions. Okay. So ESG requires you to look deeper and beyond just profits on different aspects and systematically lead to complete investment analysis, not just from profit perspective. Okay. So that is ESG investing. What does it mean? ESG investing means prioritizing ESG factors alongside profits. First line actually sums it all. ESG investing prioritizes ESG factors and performance alongside the profits of an organization. All right. So now let us cover each of the criteria in detail. First is social. Okay, we could go in order also, but social we are covering first. So social. The social criteria highlights an organization's relationship with many groups of people it engages with. Very simple. So the aim is to improve overall social well-being in a number of ways. For instance, an organization may seek to lessen inequalities. Inequalities could be in terms of gender, it could be in terms of age, it could be in terms of persons with disabilities. So it may seek to lessen inequalities. You are ultimately responsible towards the society. You have to acknowledge it. All the people should be given fair chance to, enhance their well-being, ensure human rights, and protect worker and communities' health and safety. The practices which you are taking up should be healthy and safety. I mean, typical example would be like even when I'm explaining you this, that Bhopal gas tragedy, because I saw that show recently. It's too good, to understand how, careless the management was in, letting it happen, whatever happened. So many people were killed, lakhs of people overnight. So it just showed that how businesses, if they are incompassionate, if they're not compassionate towards the society, environment, and governance, it can create havoc. The social well-being helps organizations to build inclusive, fair, and positive operations, which foster thriving communities. Social criteria span the organization from the executive offices to the supply chain factories. So it is all pervasive. The criteria applies to the leadership offices, the executive offices, to the supply chain, to the lowest levels in the factories. So employee policies and benefits, due diligence, and supplier contracts are all used to leverage the social values embedded in the corporations. So everything is revamped, keeping in mind the social attribute. The employee policies, due diligence, the supplier contracts. I've seen practically contracts in corporates being made in such a way that suppliers have to sign off, that they are not engaging child labor in their work. If you have seen, let me know. There are proper signed off documents. There is a declaration taken by from the suppliers that whatever work we are doing for you, it does not involve the work of any child. Very important. Children were being, exploited in this easy labor, cheap labor, of poorer countries. So, these sign-offs are being taken. Yes, implementation of integrity. Yes, diversity and inclusion at workplace. It is a perfect example of social ESG criteria. Organizations that go beyond ensuring that the bare minimum of rights are maintained can build a supportive work culture with their flexible work conditions, time devoted to professional development, and internal promotion opportunities. When you're working, the focus should not only be on just, working for the company, it should also be focused on how the role is helping you improve personally as a professional. What is the training and development that is the company contributing to? That is also very important. From the social criteria the companies have to maintain. All right, any doubts, any views that you have, like Gaurav shared the views on diversity and inclusion, D&I at workplace. Salman gave the example of Chinese textile industry for child labor. Anything else that you want to add with respect to social ESG criteria? Is it clear? Clear? All right, perfect. Just give me 1 second, okay? It's there. It's there. It will be discussed. We have to cover all the criteria and then it will be covered. Just give me 1 second, okay? So next we have is environment ESG criteria, right? So let's discuss this ESG criteria for the environment. So here they will cover the main environmental risks, which you were talking about, Salman. The climate change, the climate criteria gets covered here. Water security, environmental health risks, the waste burden. The more the waste that you're generating, the more burden you are creating on the environment, and biodiversity loss and extinction. Extinction meaning the flora and fauna getting extinct, no longer being there in the environment. So environmental issues are often interconnected risks which improve with a proactive approach to managing them. Organizations should do more than merely meet the bare minimum standard. Instead, they can earn higher ESG ratings by taking actions that improve the environment. You would have seen reports from Reliance Foundation about how many trees they have planted, how many girl child will come under social criteria, how many girl child they have educated. So companies are becoming proactive in terms of displaying their contribution towards the environment, society, and governance. Then business leaders who understand the benefit brought by the physical environment and natural resources will strategically pursue businesses in a way that preserves these valuable assets for generations to come. Whenever you're talking about sustainability, you have to think about the future generations. Okay. Yes, these will be examples. GRI indicators. You're right, Gaurav. It comes under CSR, but again, CSR is done to improve on these aspects only. Why is CSR done? The question, Salman, could be why does a company have to do CSR? Because they have to focus not only on profits but also on environment, society, and governance. So the underlying basis why CSR as a concept even came up was because of ESG. That companies, they have to be proactive towards all of these factors, all of these criteria, right? So that was about the environment criteria. Then we have the governance criteria. Now let us go through it. So what will this mean? We already know what governance is. Governance is ensuring that the executive directors do not abuse their power. So ESG governance includes the policies for inviting diverse board of directors. You would have heard about requirement of women directors, about requirement of independent directors. So the policies, ESG governance include the policies for inviting diverse board of directors, upholding corporate accounting standards, executive compensation. Like I gave you, for example, that Infosys non-executive directors reviewed the executive compensation, public disclosures, conflicts of interest, and other legal and ethical concerns. So there should be a very transparent governance policy of the company. In fact, like in the Infosys example also, it mentioned that the communication with the stakeholders was made very transparent so that the people are held accountable, so that the company is held accountable for its actions. Governance also covers the policies used to promote organizational fairness through a system of internal control. This prevents illegal activities from bribery and corruption to tax evasion. So you have to ensure that the board is ethical at all times, board of executive directors. So there should be policies to prevent bribery and corruption. Like in our company also, we have anti-bribery and corruption, ABC we call it, ABC guidelines. That any compensation, any gift that you're getting, or any not like monetary value, even some non-monetary support that you're getting from anyone, including government, it has to be reported. So this ensures that the governance policies are strict and no one is indulging in any sort of illegal activity. Okay, so these are the 3 ESG criteria: environment, social, and governance. Now let us just quickly put it in the form of a small summarized table, what all aspects will come under each one of them. So environmental criteria: climate change, the greenhouse gases, energy efficiency, water consumption, air pollution, water pollution, biodiversity loss and protection, deforestation, waste management, product life cycle analysis. What do you mean by product life cycle analysis? Give me an example of how it impacts the environment. Let's see. I'll ask you a question. What is the average time when you change your phones? What is the average duration you keep your phones? It's not about regular consumption, Ashish. Salman is 6 years. Wow. That's very long. Superb. Others, what is the average time you keep your phones? Someone is telling me 2.5 years, 3, 4 years, 5, 6 years, Meg is saying 2 years. Frankly, for like, even I have recently just started, after a span of 2 years, 2.5 years, you start feeling that the technology is getting outdated. You know what? The companies deliberately make the softwares, redundant, or they will make it obsolete. The system updates will make your phone slow. Deliberately, it is done so that you are bound to opt for their newer version. Correct? So what does it mean? The life cycle of the product is being deliberately made short so that customers are bound to buy new phones. I'm giving you an example, right? Product life cycle. So this is actually leading to it is an environmental hazard. the mobiles, the battery is what, how much of it is recyclable, all the electronic goods. There was a time, I'm telling you, from like my childhood days, the refrigerator we use at home, it was good, it was in very good condition for, I guess, remember, 12 to 15 years. And look at the type of refrigerators which come in the market. After 4 or 5 years, they will start showing some problem, because the quality which was being made earlier, you no longer find it, although you are paying double, triple, four times the value of it today. So this is what companies are doing deliberately, so that you're bound to make. Yes, fast fashion companies like Zara, you will today see, you buy clothes in summer, and by the time next summer comes, they have become outdated. Deliberately, these fashion changes are being made so that customers keep on consuming and buying these things. It is harmful for the environment, right? Okay, so that was about environmental criteria. Now let's just quickly summarize and see what all comes under social criteria. Human rights, child labor, wages, minimum wages have to be paid to the laborers. You can't be exploiting them by paying, you can't have bonded labor. There was a time when even bonded labor used to be there. Worker health and safety. Again, you can take Bhopal gas tragedy as the example. So many workers also died. Diversity, equity, and inclusion, giving due importance to each of the categories. Today, even you would have seen, if you're working in the corporates, there is proper representation for LGBTQ communities also, which was unheard of few years back. But today, because of diversity and inclusion being so important, proper representation is given to these communities also. Posh, prevention of sexual harassment and place. It is all about social criteria, so that women do not feel unsafe. Women or even men, whoever can get exposed to this, they don't feel unsafe at the workplace, right? So data protection, this is about diversity, equity, and inclusion, so that everyone feels included in the organization. It's not just about uh, one set of group, humans only. Everyone is made to feel equally included in the organization's policies and work culture. Data protection and privacy, data of the customers, if it is leaked, you would see so many breaches happening every now and then. A database of X number of customers leaked on the dark web. It is unethical practices. The private data of people is being leaked in the hands of criminals who could misuse it for various purposes. So many cyber frauds are happening. Why? Because companies are not proactive in terms of their data protection policies. Of course, then they have to pay a lot of fines as well if they are involved in the misdoings. But that is there. You have to ensure that the data is protected at all points. Employee and customer satisfaction. You would have heard about employment satisfaction scores. Like recently, we were also having this survey within the company, how satisfied you are with your work life. So this is important. Otherwise, why will a company even take employee satisfaction survey if they were not careful about them, if they were not concerned about the employees? Community relations, how a company interacts, the PR team, how the company is with respect to the different communities. Stakeholder engagement, again, PR exercise, how much you are able to engage with the different stakeholders. That all comes under social criteria. Next is governance criteria, board composition, inclusion of different types like women director, independent directors, executive compensation. Is their salaries, based on long-term share growth rather than just cash compensation? In only those cases, the directors will be working towards enhancing the share price, which will also benefit the shareholders, right? So executive compensation is something which is discussed under governance criteria. Taxation strategy, bribery, anti-corruption, we have covered that. Lobbying and political contribution, if you are having biasness towards any political parties, that is also something which is a risky thing, could lead to ethical issues, right? Transparency and public disclosures, whistleblower schemes, I explained it in a lot of detail. Codes of conduct, we have discussed supply chain management, all of the activities at the lowest levels, basically not just at the topmost executive levels, but even at the lowest levels of the organization, there should be a policy which uplifts the governance, corporate governance of the company. And then risk and crisis management. If there is a breach, there should be policies and procedures to safeguard the company. That also we have discussed. Is it clear? All the three criterias, have you understood them? Yes. All right. Okay. So what type of questions you can expect from here? We'll just quickly close the topic of sustainability here. Not all factors can easily be categorized into an E, S, or G category, as they often have interconnected impacts. Sometimes you will feel that it falls under two different categories, but that's completely fine. For example, reducing greenhouse gas emissions is considered important for climate change and the environment, but it also improves community health. So it is a social consideration also. Now, increasingly, businesses are also called upon to report the financial risks and opportunities linked to ESG factors. This way, they are not considered in isolation from a company's bottom line. We have the concept of triple bottom line, which we are going to study. So, even businesses are asked to report in such a way that everything it gets highlighted transparently. However, companies may struggle to quantify ESG factors in financial terms. What has been their contribution towards the society, towards the environment. They have to quantify it, and it's known as triple bottom line reporting. It is covered later. Okay. Now, what sort of a question you can expect from this concept of ESG criteria? Let us read this example. Something of this sort only will happen. They will give you an example of a company, what they are doing, what all factors they are considering, what all they are ignoring. So yeah, you will have to comment on the company's ESG policies, and accordingly, give the suitable policies for them. That is what the examples would look like. Now, Trillium, a large US asset, this is a real life example. Trillium, a large US asset management company, uses a variety of ESG factors to guidance its investment strategy. Something similar. The company is not using ESG factors in exam questions, also something like that you can expect. As well as avoiding investments in high risk areas, example, coal mining, nuclear power, tobacco weapons, or that have been involved in major or recent controversies. Okay, so it is avoiding all sorts of risky areas. Examples, human rights, animal welfare, so environment concerns, product safety. Trillium looks for investments meeting the following ESG criteria. Okay, with respect to environment, what it is doing, it publishes a carbon or sustainability report. You would have seen companies giving targets like zero carbon footprint. You would have seen Zomato coming up. Our products are completely green. Zomato had recently launched a campaign for that. Yes. So what actions the companies are doing for each of these criteria, that is something that could be asked in the exam. Right? So environment, it publishes a carbon report, carbon and sustainability report. It limits harmful pollutants and chemicals, seeks to lower GHG emissions and carbon oxide footprint, uses renewable energy sources, reduces waste, right? So I would suggest you treat this table as important, something which you should revisit during the exam, summarized form of ESD, what all factors are considered, what all issues could be there under each one of them, so that you get ideas while drafting your answers. Then social. Operates an ethical supply chain, avoids overseas labor that may have questionable workplace safety or employ child labor. So it is away from all sorts of controversies. It is not employing child labor. It supports LGBTQ rights and encourages all forms of diversity. It has policies to protect against sexual misconduct. It pays fair wages to the staff, to the labor. Governance, what it is doing, it embraces diversity on board of directors, inclusion of basically independent directors. It embraces corporate transparency. The communication with the stakeholders is kept transparent. Someone other than the CEO is a chair of the board, and staggers board elections. There are elections to the board. It's not like imposed board. It is a elected board, like a democracy, you can say. So this is what a governance criteria will look like. Right? This was a real life example from a US company. Is it okay? I mean, I hope you would have understood. Any point that requires further discussion, please let me know. Or we can move to the next slide. Clear? All right. So the next topic, again, a new amendment in the syllabus, and that is green finance. Very, very important topic. Let us understand. Green finance, again, theoretical topic, but very much relevant in today's scenario. Let's go through it and understand. Companies that are pursuing environmental sustainable agenda are likely to require finance to support investment in projects that provide environmental benefits, such as reduction in air, water, and land pollution, reduction in greenhouse gases, and improved energy efficiency. What it is saying is, if a company is pursuing environmental goals, then it needs to be supported with investments in such projects. How will it finance it otherwise? So, green finance is a term that is often used to describe the financing of such investments providing environmental benefits. So, green finance, very, very simply put, is about financing environmental projects. In addition to a company's normal sources of finance, some additional sources exist with a special focus on green issues. COP28. It is currently happening in Dubai, right? So, that is the focus, how you can raise finance for environmental activities. So we have here green bonds. A green bond is a type of fixed interest bond used to raise money for climate and environmental projects, right? Again, same as bonds. Normal bonds, you would have raised money for doing business operation. Green bonds is what? Raising money for climate and environmental projects. So these bonds are typically secured and have the same credit rating as a company's other debt obligations. Very simple concepts, nothing to, worry or get complicated in mind. Very simple concepts. So green bonds may come with tax incentives. Of course, government would want to promote such bonds. When you are raising money to do some sort of an environmental benefit, definitely government will want to promote it. So green bonds may come with tax incentives to encourage their use. Example, no tax to pay on interest earned. So if you are providing, as an investor, you're providing money to green bonds, the interest that you will earn, it will be tax-free. So you save a lot of money, which may mean that they can be used by a company with a lower coupon rate. So the company can also provide lower interest rates, right? So because it is about the willingness of the people to be environmentally proactive. So they will be fine with lower interest rates also. They want to contribute towards the environment. Okay. So green bonds may also be cheaper because of rising demand for such bonds, and because there is often a view that companies who have an ESG strategy are seen as better borrowers from a credit risk perspective. Because just think about it as a layman. If a company is willing to invest in environmental projects, then definitely it would be doing well in its core projects. So, companies which are coming out with green bonds now, they are considered to be good borrowers. Okay, and definitely they enjoy a better credit risk rating. Okay, so to qualify for green bond status, they often need to be verified by third parties, such as the Climate Bonds Standard Board, which certifies that the bond will channel finance to environmentally beneficial projects. Now, imagine that type of fraud. Companies are raising finance for environmental projects, but they're channeling the finance for their core business. That will be like a fraud, no? So, companies, they have to get it audited or they have to get it certified properly that the funds are being indeed used for environmental projects. So over the past decade, green bonds have increased in popularity dramatically. Okay. Similar to normal loans, we also have green loans. So some banks, often with government backing, specialize in financing green projects. For example, in the UK, the Green Investment Bank, GIB, was launched in 2012 to finance investment in reducing greenhouse gas emissions, promoting efficiency in the use of natural resources, protection of the environment, and promoting environmental sustainability. Imagine a bank has been instituted just to finance green projects. The GIB was privatized in 2017. Now, the Green Investment Group, but retains the same goals. Yes, so Gaurav has given a very good example. BlackRock, Vanguard, UAE government, and Brookfield has created financing for green projects. State Street, I haven't heard of, but these projects I'm aware of, which Gaurav is even stating. So State Street, I don't remember per se. But there are projects which are being done at such large scale. Okay, I'll also research about the State Street. Such big projects are being undertaken to promote environment in a way, to protect the environment. All right. So, unlike green bonds, green loans may potentially be cheaper than standard loans due to possible government incentives and high demand for this type of business from banks. However, such loans often carry a high administrative burden to the borrower, who will need to demonstrate again. It has to be demonstrated, it has to be audited that the money is being used for environmental purposes only. So you have to demonstrate compliance with the terms of the loan. So there may also be consequences to the borrower for breaching the ESG provisions and the loan no longer being considered green. For example, if you are, misusing the funds, if you are channeling the funds in wrong ways, in other ways, then you could be fined by higher interest rates, or you could be asked to immediately pay back the loan. So these could be the repercussions of not using the money of green loan for the stated purpose. Okay, so that is about green bonds and green loans. Is it clear? Let's move to the next topic then. Super. Next topic is sustainability linked loans. So sustainability linked loans are loans for any purpose, whether green or not, with an inbuilt pricing mechanism that reduces the cost of the loan if the borrower achieves sustainable or ESG related targets. So sustainability linked loans, these are not given with the objective of just doing or meeting ESG criteria. You may use it for any purpose, but your interest rates will reduce if you are meeting ESG related targets. So it's a flexible loan. Okay. So sustainability linked loans. Very simple. So the ability to utilize SLS, all of these are all green types of finance. That is what the topic is about. So the ability to utilize the sustainability linked loans across the range of projects rather than financing a single asset. Because like you would have seen in green loans and green bonds, you were financing a single project and that was green. But here you're giving that flexibility to the borrower. You may use it for other purposes, but then accordingly your interest would be adjusted. It has added this SLLs have added to the attractiveness of this source of green finance, and the use of SLLs has grown rapidly in the recent years. Okay. Next, we have green equity funds. You have normal equity funds. This is a green equity funds. So many stock markets produce an index of firms that satisfy social and environmental criteria. For example, in the UK, the London stock market have the FTSE 4 Good Index. To be included in the FTSE 4 Good Indexes, companies must, for example, support human rights, make progress to become environmentally sustainable, and ensure good labor standards for their own company and for companies that supply them as well. Suppliers declaration is also very important, because if you are using the services of a supplier who is engaged in unethical practices, then your name also gets dragged in the mud. So this helps investors to target investments in company with higher standards of behavior in terms of social responsibility. So you can become a part of this league of companies who are displaying that we are very much into meeting all the ESG criteria, like we are not hiring child labor, we are following environmentally sustainable practices. So you can become a part of these indexes. So as with other forms of green finance, the reduction in risk from compliance with high ESG standards can mean the investors are happy with a lower return. That is the reduction in the cost of equity, because the investors, they are proactive. They want to proactively support environmental protection. They will know that proper audits would be done of the companies to show that they are complying with the green standards. Correct? So that is about green equity funds. Is it clear so far? Green equity funds should also be fine. Next is, as a concept, completely new. That is, as I said, we'll learn about this triple bottom line reporting. Okay, let us understand about it. All of these are new topics. I mean, till the previous batch, it was not there. Be it the sustainability concept, be it the concept of green finance, be it this concept, all of them are new. Triple bottom line reporting. Let us understand. The phrase triple bottom line was coined by John E., co-founder of the business consultancy Sustainability. It is an expanded baseline for measuring performance. Normally, what is the bottom line of a company? It is called the profit. But triple bottom line, it is an expanded baseline for measuring the performance. You are expanding on that profit. Now, how it is done, let us understand. Triple bottom line accounting attempts to measure and report corporate performance against economic, social, and environmental benchmarks in order to show improvement or to make more in-depth valuation. See, economic view you were already giving. Profit is what? Economic view of the profit. Now, extended baseline, triple bottom line, economic is there. Social and environment is getting added newly. So the triple bottom line accounting attempts to measure and report corporate performance against economic, social, and environmental benchmarks in order to show improvement or to make more in-depth evaluation. Adding governance to the bottom line makes it quadruple bottom line reporting. So currently it is more, TPL is more popular. If you're adding governance also, like E, S, and G also you're adding in addition to the economic criteria, then it is known as quadruple bottom line reporting. In syllabus, we have triple bottom line reporting. All right. So it can be viewed as a reporting device, that is information presented in annual reports, and an approach to improving decision making and the activities of the organization. Example, by providing tools and framework for considering the economic, environmental, and social implications of decisions, products, operations, and future plans. Don't worry, you don't have to memorize all of this stuff. Just know it as a concept that in triple bottom line, you are expanding, you are reporting. What does it say? It can be viewed as a reporting device, that you are reporting on economic, then environmental and social benchmarks. So it is a reporting device. And when you are reporting on these three lines, it helps in improved decision making, and the activities of the organization can also be guided properly. Right? That is about TBL's objectives or what it is set out to do. Now, let us understand what are the advantages and disadvantages. You can expect questions like evaluation of the concept of TBL because this is a new concept. So you need to be really, really aware about the pros and cons of this as a concept. Let us understand. What is triple bottom line reporting? Very simply put, expansion of the bottom line reporting into economic, environmental, and social. And if governance is also being included as a part of reporting, it becomes quadruple, right? Okay. Now let us understand what are the advantages and disadvantages of TBL. Advantages number one, it makes transparent the organization's decisions that explicitly consider effects on environment and society, as well as, of course, on financial capital. So definitely it is making it transparent now how much the organization is contributing towards economic, how much it is contributing towards society, how much it is contributing towards environment. So it makes transparency in the organization's decisions. Next, more informed decision making, as decision makers can quantify trade-off between different aspects of sustainability. So basically, when you are reporting separately, environmental, social, and economic criteria, then any decision that you are taking, what its impact would be, that can be understood. If I'm taking this decision, my environmental profitability will come down, but my economic profitability will go up. So in this way, you can understand the trade-offs that are happening because of each decision. So more informed decision making, as decision makers can quantify trade-offs between different aspects of sustainability. Or maybe, if a decision is increasing environmental impact, but it is reducing or having a negative impact on the society, then these trade-offs can be understood and accordingly the decision can be taken as to what is more important to the organization. Third advantage is improved relationships with key stakeholders and improved risk management through consultation. So when you are proactively trying to uphold the interests of different communities, their relationships will definitely improve. Specific commercial advantages, example, competitive advantage with customers. Customers who are environmentally friendly, they will prefer such companies who are involved in triple bottom line reporting, right? Even suppliers will favor you with good terms, good prices, and providers of finance may provide you loans at lower interest rates because they see that you are environmentally and socially aware, not just economically aware. Okay, and the last advantage is enhancement of reputation and brand. It may result in attracting and retaining employees with sustainable values. So if the employees are also, proactive in terms of protection of the environment and society, then they will also be, high grade employees will be interested in working with you. So these are the advantages. Now, what are the disadvantages? See, you do not have to prepare a triple bottom line financial report in the exam. It's just that conceptually it is being informed to you. So this is what is, I would consider, the most important aspect or most important topic of triple bottom line, the advantages and disadvantages. So be 100% clear. Disadvantages. Now, there are currently few standards for measuring these effects. See, like you have IFRS for measuring the economic performance of the company, do you have such measures or, IFRS or reporting standards for social and environmental impact? You don't. So there will be a lot of uncertainties, ambiguities, or inconsistencies in the way in which these will be reported. It will not be, like when a statement or when the financial statements are prepared using IFRS, how it is prepared. There are standards which are guiding the preparation of it. But in case of environment and society, it's not so. Usefulness and comparability, as there is significant variability, as I said, inconsistencies. So will you be able to compare with different companies, or maybe even compare the performance of a company over time, because company can change its policy over time. So comparability issue will arise. You will not be able to compare it with different companies or within the company also. The difference between the economic bottom line and the financial bottom line is often blurred. Like even I'm telling you, like economic perspective, it is often considered in the same way. This is a disadvantage. There is no proper demarcation between your financial bottom line and the economic bottom line. It is considered to be on similar lines. Then another disadvantage is increase in annual reporting costs with disproportionate costs for smaller entities. So, the scale of a company will also be very important. So, for example, a small company, let us say, which is making a lakh rupee profit, and it has to report on this triple bottom line, the proportion of cost which it would be contributing, it could be high. The proportion of impact that it has created on society or environment, that could be high. Now, like a 20%, the 20% of that 1 lakh rupee P&L statement could be higher percentage wise, but value wise it could be small. But for a large organization, that 20% could be substantial, and it might give distorted presentation to the investors, because they will be seeing that 20% of a company is being contributed towards society, whereas this company is just contributing 2%, but value wise it could be substantially different. So this, it leads to disproportionate costs for smaller entities, and of course their reporting costs also goes very high. When you are reporting on these detailed aspects, now imagine a small company doing all of these activities. Imagine the type of fees auditors would be asking, or the accountants would be asking for it. So there is an increase in annual reporting costs with disproportionate costs for smaller entities. Next disadvantage is potential exposure to risk and liability relating to the reliability of the report's content. Of course, you need to be audited properly. Then only the report would be considered as reliable. Otherwise, anyone can report anything they want to. So there is exposure to risk. And lastly, potential bias in voluntary presentation. You can see, because there are no IFRS around this, so you can present in whatever way you want to, right? So potential bias in voluntary presentation. It is voluntary, it's not mandatory presentation, so you can do any type of bias that you want to, right? So these are the advantages and disadvantages. Take a moment, have a look at the slide again, go through it and let me know if you have understood. Any point you wanted to discuss again, we can do it. Yes, there, of course, the scope of work will increase, right? So their fees will also increase for the auditors to comment on it, or for the accountants to prepare such reports. So definitely the report, I'm sure you're asking about this point. So definitely there will be increase in annual reporting costs. Your cost will go up because you're asking for more detailed reviews from the accountant and the auditors. So this leads to disproportionate costs. Now, smaller entities will not be able to afford these type of costs, right? That is what it is. See, Gaurav is giving insight that big fours are charging millions for sustainability consulting. It is a hot topic, actually. If you develop expertise in this, it could be, a game changer, because it is a hot topic. Companies are, being proactive in terms of reporting this to their stakeholders. So, the people who are, consultants in this area, they are making good money. Yes, definitely. Salman, this is something you could learn in Big Fours specifically with respect to the consultation in this. Oh wow, Gaurav is also part of one such project of implementation of ESG. Definitely, you would have a lot of insights in this. Very good. So, what have you learned, Gaurav? What has been your experience? Salman is saying so. Gaurav makes millions. What has been your experience, Gaurav, in terms of ESG? It's very wide, definitely. And you know what? See, that is what the disadvantage is also. It is the lines are blurred. How do you define some things like between economic or between financial or, how to report it? It's all very varied and there's no consistency in the format because there are no laid down standards as of now. So definitely it will be, a little painful exercise to be learning it, to be doing it. But yes, the companies are actually getting involved in this type of activities more and more now. All right. Then exactly, hurdle is quantification. How do you quantify the efforts? Absolutely right, Gaurav. You're okay. Let's come to the last slide. That's, I mean, all the concepts of environment and all. It's just the last slide of this topic. We'll cover it. Okay. So it's just a summary. In indicators of impact. Now, economic will be gross operating surplus, dependence on imports. Now, this is a fine tuning of that financial reporting and economic reporting per se. If you see, if you are depending on imports, a lot of I mean, and money gets involved, right? You have to pay import duties and all, and long transportation happens. So transportation costs are very high. So indicators of impact, gross operating surplus is your basic method of calculating surplus. Then dependence on imports, stimulus to domestic economy. Recently, Narendra Modi, the Prime Minister of India, he commented that, wed in India. Because, recently families have started going outside of India for marriages. So he said, wed in India. Why? Because when you are, going outside, the economy of that country only benefits now. So when you are doing it domestically, not just like I'm giving you an example of weddings, but since it is the wedding season now, so when you are doing business depending on domestic counterparts rather than depending on international counterparts, you are contributing to the economy in a way, right? So stimulus to domestic economy by doing local purchases, right? So that is about the economic indicators. Next, we have social. For assessing the impact of social impact, assessing the impact of social factors, you need to consider the health and safety records. How many accidents have happened at the workplace? How many people have been admitted to the hospitals? Injuries. So all of those records should be gone through to understand the social impact, tax contribution, employment, how much you are, how many people you are employing, what is the diversity of the employees. There are actually norms within the companies whereby, each team is supposed to have minimum one woman employee, because normally the work culture is skewed towards male employees. So, they instill such norms so that, not like a mandatory thing, but if you are doing it, it's considered to be a good sign for the team that you engage more people from, different communities of like women employees also. So employment, what is the employee profile like? That is an indicator of social impact. Okay. Next, we have environmental. So here we have the carbon footprint. I give you the example of Zomato here. Then emissions to soil, water, and air. You can check the environmental records for this. And water and energy use. Easily quantifiable, how much water you have used, how much power and electricity you have used, how much of it is renewable, how much of it is non-renewable. All of these things can be assessed to arrive at accurate triple bottom line reporting. Such indicators can distill complex information into a form which is accessible to stakeholders. Like Gaurav is mentioning, it is very painful task to quantify. But when the consultants have quantified it and the reports are presented to the stakeholders, it is a very cakewalk for the stakeholders. No, they just have to read the report and understand. So such indicators can distill complex information into a form which is accessible to stakeholders. Organizations report on indicators that reflect their objectives and are relevant to the stakeholders. One difficulty in identifying and using indicators is consistency, as I've already highlighted, because there are no standards till now. So there is a problem with respect to the consistency in an organization over time and between organizations. So maybe a company's report over the years and also as compared to different companies, it will be inconsistent. So this is a difficulty with triple bottom line reporting. Okay. So just to conclude, what is triple bottom line reporting? Reporting on economic, environment and social factors, the bifurcation of profits, so that you assess the impacts of these different types of indicators separately. And the stakeholders understand what is the company's contribution towards the different criteria. Okay. That is about TBL. There is a question which I want all of you to take as homework. You can take a screenshot of this page, or by the time you get the notes also, notes may come to you by Tuesday or Wednesday. So you can take a screenshot if you want to try it today. Take a screenshot of this question. Please try it at home. I'll read it out. What are the requirements? Explain what TBL reporting involves and how it would help demonstrate triple tiples sustainable development. Include examples of measures that can be used in a TBL report. Answer all parts, okay? Please, everyone, I request you to try it at home. Only if you keep on practicing with the class, then only you will learn and grow. Otherwise, you think that only by reading the concepts you will be able to prepare yourself for the exam. It is a myth. You have to practice, right? So please practice it at home. Second requirement is discuss how producing a TBL report may help management improve the financial performance of the company, providing examples where appropriate. So the board of directors of Triple Tipple are discussing whether to adopt a triple bottom line reporting system, increasingly used by the company's competitors. The board would like to demonstrate the company's commitment to sustainable development, but is concerned that the cost of TBL reporting would exceed the benefits. The question which you were asking, will fees be high? Like even Gaurav mentioned, millions are being charged. So that is a point that it is concerned that the costs of TBL reporting would exceed the benefits, particularly as TBL reporting is not mandatory. Today also it is not mandatory. It is not mandatory for external reporting purposes. Should it undertake? Okay. So this is the question. I hope all of you have taken a screenshot. When we meet on Saturday next week, we will discuss the answer of it. Okay. Everyone, please confirm if you have taken a screenshot. You can press Windows Shift and S on the keyboard, drag the rectangle and save it in a Word or an Excel file. Yes? Perfect. Perfect. All right. So then let's pause here for this week today, and you'll get the notes, right? This chapter is over here. So you'll get the notes of this chapter and the introduction deck, which I had shared with you. Okay, so there is a sheet in the introduction Excel sheet. Okay, report related requirements. Don't read it now. I will be discussing it with you later. How you should be drafting the answers for report related questions. When I'll be giving you homework from the report based questions, then I will explain it to you. Just keep it with you. In introduction Excel file, there will be a sheet called report requirements. So just keep it. Don't worry that ma'am didn't discuss it, but she has shared. But I will be discussing it later. All right. So go through the notes at home, read it. If you come across anything which you could not understand or you want more clarity, just note it down and we will take it up in the next class. Okay. Thank you so much for attending the class so patiently today. Bye-bye and take care. Thank you. See, Salman, since we are having live classes, it is better to ask doubts in the class so that everyone can hear it. And it gets recorded also for future consumption. Okay, Salman? Okay, bye-bye.